Dear ladies and gentlemen, good evening or good morning, depending on which part of the world you are joining us from. It is with great pleasure that we welcome you to the JCLE Conference organized under the auspices of the Hellenic Competition Commission on the topic of common ownership, interlocking directorates, and competition, a transatlantic perspective. Needless to say, the topic we will be discussing today is one that has raised significant issues of much interest from an antitrust perspective and has sparked vivid debates within the antitrust community. Joining us are esteemed professionals from both sides of the Atlantic, key experts and policymakers to contribute their valuable insights gained from their experience in their respective fields. In the interest of a productive and lively discussion, we encourage active participation from our audience. To this end, you may ask questions using the chat window feature, which you will find on the webpage of the Hellenic Competition Commission, from which you're watching the conference, so that the speakers may have the opportunity to answer your questions during each panel. As we have a full work schedule ahead of us, let's go right ahead and delve into our discussion. So without further ado, I would like to introduce our event coordinator, Dr. Florence Thépot, lecturer from the University of Glasgow, to extend a welcome to all and to make an introduction to the conference. Mrs. Thépot, the floor is yours.
Thank you very much. Good afternoon. It is a great pleasure to welcome you all to the Journal of Competition Law and Economics Conference on Common Ownership and Interlocking Directorates. I am Florence Thépot, an associate editor to the journal and lecturer in competition law at the University of Glasgow. I am delighted to organize this event together with Amelia Fletcher and Martin Peitz, editors to the journal. I would like to thank them for their precious contribution to every aspect of this conference planning. Thank you very much to the Hellenic Competition Commission, to President Lianos and members of staff for hosting us today virtually, although I wish we could all be in Athens today. My thanks also go to other organizations that support this event. The Center for Competition Policy from University of East Anglia, the Mannheim Center for Competition and Innovation, the UCL Center for Law, Economics and Society, and the University of Glasgow. This event will feed into a JCLE special issue on common ownership and interlocking directorates. This special issue, to be published in 2021, will feature important and recent evidence by experts on the topic. Today, we have the great honor to gather our authors, other key experts, and policymakers for a discussion of the evidence and policy implications, if any, of common ownership and interlocking directorates. So what is unique about today's event and why you should stay with us until the end? This event will enable an evidence-based policy discussion of some of the most hotly debated issues in competition policy these days. Common ownership and interlocking directorates are very interesting and complex matters at the crossroads between corporate finance governance and competition policy. Our speakers will fuel this debate with a unique combination of economics, legal, and policy insights. Although it emerged in the US, the debate on common ownership is now very important in the EU. However, differences in types of capitalism, corporate laws, or institutions may demand a regional or jurisdiction-specific analysis. Thus, today, we are very lucky to have key figures of the US debate with us and to hear from those researchers and policymakers who now deal with this issue in Europe, be it at EU level or national level. Finally, this event is the first, to my knowledge, to dedicate a whole panel to interlocking directorates. Interlocking directorates exist when companies have corporate board members in common. They can be combined with financial links, but not necessarily. Although they are less visible from the debate, they raise issues that are similar to common ownership. A transatlantic discussion of these is very interesting. While the US has an express ban on interlocking directorates between competitors, the EU doesn't. Recent empirical evidence suggests we may want to look at these issues more closely. To all speakers and panel chairs, thank you. I am extremely grateful you accepted to take part and look forward to the discussion. I also want to thank our audience for joining us today. Please share your thoughts on Twitter with the hashtag JCLE Conference. I wish you all an excellent conference. Thank you.
Thank you, Dr. Thépot. We are anticipating with great interest your presentation during the first panel, but now I would like to yield the floor to the President of the Hellenic Competition Commission, Dr. Ioannis Lianos, to welcome you and to guide us through our discussion by presenting key remarks. Mr. President, the floor is yours.
Thank you very much, Silvia and Florence. Ladies and gentlemen, I'm Ioannis Lianos, the President of the Hellenic Competition Commission. It is my pleasure to welcome you today and our speakers and teleconference participants for this particular event. This forms part of the recent initiative of the Hellenic Competition Commission to promote discussion and public awareness over important issues of competition law and policy, and in particular to participate in the international and European discussion on this particular topic, initiated in Europe at least, by Commissioner Vestager in a speech back in February 2018. And of course, the issue of common ownership was reviewed extensively by the European Commission in the Dow-DuPont merger in 2017. The financialization of the modern corporation has been a marking feature since the 1970s, and this process has led to an important increase of the profits of the finance sector, finance, insurance, and real estate, while the profits of the manufacturing sector dropped during the same period. It also led to a significant increase in the share of financial assets held by the non-financial sector of the economy, and an increased importance of financial revenue for non-financial businesses. This period coincides with the prevalence of the shareholder value principle, which dominated corporate governance discourse since the 1970s, and the subsequent focus on short-term share price. The shareholder primacy principle changed managerial priorities from that of maximizing growth by reinvesting corporate savings to the long-term productive potential of the corporation, the principle of retain and reinvest, to that of maximizing stock value through extensive buybacks of corporate stocks, share repurchase, in order to inflate stock prices as a resulting artificial scarcity of shares boost their value. An important facet of the financialization movement has been the increasing leveraging of corporations through debt and other hybrid financial instruments, and consequently their dependence on the investments of some institutional investors, which increasingly now own shares in publicly listed companies instead of physical persons. The rise of institutional investors constitutes an epiphenomenon of this growing financialization of the economy. This is a quite disparate group of legal entities whose purpose is mainly to manage and invest other people's money, although this is not always the case, and there are hybrid forms of equity funds in which the managing partners co-invest with the limited partners. These include traditional financial investors, such as investment funds, in particular index funds, pension funds, and insurance companies, as well as alternative institutional investors, such as hedge funds, private equity funds, sovereign wealth funds, and exchange-traded funds, as well as asset managers. The degree of engagement of these institutional investors in the competitive strategy of the corporations they invest in varies. One may contrast active hedge funds or mutual funds. Index funds are investment funds that track mechanically the performance of an index and are presumed to be passive, as they have little incentives to invest in the stewardship of the companies in which they are present. Hence, they differ excessively to the positions of corporate managers. Because of their passive nature, they're not concerned with firm-level performance, as will normally active shareholders do, but to the extent they're investing in a group of companies, they're simply concerned by the performance of their portfolio firms, without, however, their internal structure and governance leading them to engage with the governance of their portfolio companies. The institutional investors and asset management market has witnessed in recent years a significant process of concentration. Recent research has found that the 20 largest asset management firms around the globe account for 43.3% of the top 500 managers' total assets under management, and represents around $93.8 trillion in 2017, the highest level of concentration at least since 2000. Passive index funds such as BlackRock with 6.3 trillion total AUM, Vanguard Group with 4.9 trillion total AUM, and State Street Global constitute the top 3 asset managers globally back in 2017. The concentration of corporate ownership resulting from the concentration of the asset management market may lead index funds to be more actively engaged with corporate strategy and influence corporate management, either actively by exercising the voting power of the shares owned by their funds, or more indirectly by simply doing nothing. This may induce corporate management to internalize the index fund's interest in competing firms in view of the fact that their importance in the shareholding has risen significantly in recent years. The combined effects of the shareholder value primacy and the rise of common ownership, as well as a subsequent concentration of asset management, have important implications on the competitive strategies undertaken by the management of corporations. Together, they challenge the assumption of own firm profit or value maximization that has animated industrial capitalism since the 1930s, which forms part of the neoclassical theory of the corporation. Subsequent literature has challenged the separation theorem, finding that the turn to shareholder primacy in the late 70s, with the emergence of financialization and the fact that the shareholding of public corporations is less dispersed, resulting from the rise in common ownership, may have multiple effects. It may, for instance, increase the influence of shareholders in determining the utility function of the corporations in which they invest, thus challenging one of the assumptions of the thesis separation principle. Secondly, it may lead shareholders not to want firm profit value maximization, but instead maximization of the value of their whole portfolio of shares in other firms present in the industry. And thus it may result in altering corporate managers' incentives to aggressively compete on product markets with competing firms in which the common owners also hold shares. It's, however, only recently that shareholders overlap, as can be observed in situations of common ownership, the situation in which several companies are owned or influenced by one person or organization, and or cross-ownership, the situation in which 2 companies hold shares in each other, has attracted the attention of competition authorities. The possible anti-competitive incentives created by cross-ownership and common ownership in concentrated product and geographic markets have long been recognized in theoretical literature. Work by Rothenberg in 1984, Bresnahan and Salop in 1986, Reynolds and Snap in 1986, Bryan and Salop 2000, Gillow in 2000, and Gillow again with others in 2006, but lack sufficient empirical evidence. Recent empirical analysis of the US airline industry by Azar, Smaltz, and Teku, banking industry by Azar, Raina, and Smaltz, as well as the food industry with a contribution of my own with Alina Velios and Katalevsky, have reignited the debate by measuring the potential large effects of the common ownership on price levels rising above the competitive ones. These findings resulted in policy concerns expressed by the Council of Economic Advisors to the White House in 2016 and by academics such as Einar Elhaug, and proposals for legislative interventions such as the one by Eric Posner, Fiona Scott Morton, and Glenn Weil in 2017, and criticism of the findings by, for instance, work by Rock and Rubinfeld in particular. And the topic now becomes of quite importance also in Europe with the publication of the recent joint research study on the topic commissioned by the European Commission on the topic of common ownership and exploring the situation in Europe. So the topic is now more mature for discussion, and I think we have the opportunity today to progress on our knowledge of this particular issue, as well as probably discuss some policy responses to the problem. So we're very glad and very happy we have this session today in collaboration with the Journal of Competition Law and Economics and our university partners. Thank you.
Thank you, Mr. President. We eagerly await your further insights later during your presentation in panel 3. We will begin our discussion with the topic of interlocking directorates, which will be discussed in the first panel. Our moderator for the first panel is Dr. Amelia Fletcher, CBE, a professor of competition policy at NBS and deputy director at the Center for Competition Policy at the University of East Anglia. Dr. Fletcher will present the speakers for the first panel. Welcome, Dr. Fletcher. You may proceed with the discussion.
Limited time for this session. We've just got an hour. So I'm not going to do a long introduction. I think that Florence and Ioannis have already really very well motivated why we're having this conference and why this issue is so topical. Certainly interlinkages between firms generally is been increasingly topical. That said, I'd say, and Ioannis, a lot of what he said related to the issue of common ownership across rivals, and a lot of the discussion has been in that space, and that's what we'll be looking at in the second session today. But less focus to date, I think, has been given to the question of interlocking directorates, and that's the subject of this topic, this panel. And clearly, to the extent that board directors have some power, and you might think that they should have some power, this would seem a really natural route for influence across firms if you have interlocking directors. You might well think that it could facilitate collusion, or at the very least, the relaxation of competition. As Florence mentioned, and maybe surprisingly, this is actually an area where the US law is in theory at least stronger than EU law, in that directors that serve on the boards of competing firms risk violating Section 8 of the Clayton Act, as well as various other rules around fiduciary duty. Nonetheless, as we will hear from Yaron Nili later, it's far from obvious that the US can in fact be given a clean bill of health in this space. And there's a very clear and direct question as to whether policy is in the right place, either in the US or even more in the EU. So I'm going to introduce each speaker briefly before they speak. I'm going to be pretty tough on timing. They've each got 10 minutes because I want to have a little bit of time for Q&A at the end. If people have questions, please feel free to be putting them in the live chat, or I will also keep an eye on the Twitter, so that hashtag JCLE Conference tag. So with that, I will hand over to our first speaker, who you've already met, Florence Thépot, who, as she said, is a lecturer in competition at EU law and EU law at the University of Glasgow. She has written a monograph on the interaction of competition law and corporate governance, and has a particular focus in her work on interlocking directorates and their implications for competition. So, Florence, you take the floor.
Thank you very much, Amelia, for this introduction. So I'd like to talk to you about the issues raised by interlocking directorates in Europe. What may be the anti-competitive effects when competitors share common board members? Is EU competition law well equipped to address potential issues? How about corporate law or corporate governance of member states? In 2009, Eric Schmidt, CEO of Google, stepped down from the board of Apple. Why? Because in the US, as we know now, Section 8 of the Clayton Act prohibits an individual from serving on the board of two competing companies. Louis Brandeis, back in 1914, explains really well, I think, the spirit of this prohibition. He says, interlocking directorates are the root of many evils. They suppress competition and also violate the rule that no man can serve two masters. And I think he explains really well the concerns both from a competition and corporate governance perspective. In Europe, there is no such prohibition apart from Italy in banking and financial sector, as we will hear. Interlocks may be direct, one individual sitting on the board of two competitors, but also indirect. It may be one company or investor sending two separate persons to sit on the board of two competitors. Most interestingly, I think, is the extent of these links that can create corporate networks. So companies would be linked via a net of these corporate connections. In Europe, interlocking directorates are a particular feature of continental European economies, such as Germany or France. So that's typically, which has led to the qualification as the small world of corporate governance or cooperative capitalism. Since the 90s, it seems there is a decline of the density of the corporate networks created by corporate board links, but national corporate networks do persist. What may be the issues from a competition law perspective? First of all, issues of collusion. Interlocking directorates give access to a competitor to strategic and sensitive business information regarding future commercial strategy, accounting, or appointment and compensation of top executives. As such, we understand well that this information exchange may facilitate collusion, be it explicit or tacit. But another aspect which I think is interesting and even more interesting is just the unilateral impact of these interlocks on the incentive to compete. Maybe sharing common board member just soften competition in general, may discourage companies from competing aggressively with their rivals if they are connected within a network of these corporate board links. And of course, these would depend on the extent and the frequency of these links within an industry. Of course, we understand as well that interlocking directorates within sectors may give rise to efficiency gains related to the resource an individual who has experience within a sector may bring regarding its expertise and information, may reduce strategic uncertainty. There are very few studies on the impact on competition of interlocks. Among these studies, Gonzalez and Schmidt show that companies with a high fraction of busy directors may be more likely to participate into cartels. Buchhansen, however, find little correlation between interlocks and convicted cartels based on commission decisions regarding cartels between 1969 and 2012. However, these studies only concern detected cartels, which is only the tip of the iceberg, and doesn't say anything about impact of interlocks on unilateral incentive to compete. I myself computed some statistics based on John Connor's cartel statistics, and I found quite striking that among 52 firms convicted for anti-competitive conduct, so cartels, more than a third of international cartels are French or German companies. And to give a comparison, only 15% of them are entered into by US or UK firms, while they represent larger economies in aggregate. So here I'm just asking question. I'm not finding any link of causality, but I'm just asking whether these interlocking directorates may have helped, may have facilitated the conclusion of these cartels at this time. Of course, knowing that other factors play a great role in explaining why maybe French and German companies were active in more cartels. Is EU competition law well equipped? EU merger regulation may scrutinize interlocking directorates to the extent they are part of concentration or an acquisition in general. And as such, some directors have been required to step down from competitors' board to remedy competitive concerns. But the first shortcoming here is that there needs to be a lasting change in control for EU merger regulation to scrutinize interlocks. Article 101 may, of course, help mitigate the coordinated effect and the collusion aspect of interlocks. First hurdle, we must find perhaps an agreement between two undertakings. Is the nomination of a board member an agreement between undertakings? I don't think so, because it's most of the time a unilateral act from one company which appoints just an individual. But we know that flows of information may be captured by Article 101 depending on the type of information exchanged. Yes, but in practice, how do you evidence information that may be received by one individual sitting lawfully at the board meeting, and maybe he's like integrating this information? How can you evidence collusion, anti-competitive collusion in the private remit of a board meeting? Also, big shortcomings, Article 101 will not address unilateral effects of interlocks on competition. But maybe we find limitation in corporate laws of member states, and indeed some countries do set some limitations, for example 5 or 3 depending on the type of company. In France, Germany up to 10 mandates. But these apply across the board of sectors. And I think for me, 3 would be already too much. Imagining someone sitting at the board of 3 competitors cannot remedy whatsoever the competitive risks. However, we also have principles of corporate governance which may further limit issues we may have. Directors must be independent. They owe fiduciary duties to their corporation, and as such, they may be able to act in the best interests of their company, irrespective of the holding they have. And as such, we understand why codes on corporate governance typically set limitations on the number of seats individuals may hold. But they are generally non-binding, and they do not remedy, I think, conflict of interest raised by the fact that how can a man or a woman serve 2 masters. In conclusion, mind the gap. I think there is clearly an enforcement gap in theory, but second question, does it matter? And to do so, we must know what is the economic impact of interlocking directorates in practice before we take any action in Europe. Very interesting, especially for today's conference, what is the combined effect of corporate networks via boards to that of financial ownership links created by common ownership? Interlocks, of course, may provide a channel of influence. And is that a proxy for a bigger issue? Maybe interlocking directorates reflect a wider corporate elite, which may give rise to wider issues regarding competition. If we were to remedy enforcement gap, we could go perhaps 2 routes. European Section 8 have a prohibition of links between competitors, corporate links between competitors, or maybe we could think about having member states setting further limitations via their own corporate laws. And also a little advertisement to my monograph on the topic. So in that book, I discuss these issues. Thank you very much for your attention.
Thank you very much, Florence. Well, that was a really incredibly clear setting out of the issues, as well as an exhortation for future work. And I think we'll go straight on now with Yaron Nili, who is Assistant Professor of Law at the University of Wisconsin-Madison. And he's looked at the empirical position on interlocking directorates in the US, as well as considering the legal position. So please take the floor. Yaron, we can't hear you.
Can you hear me? Can you see my slides?
We can see your slides, and now we can hear you.
Perfect. Thank you. Okay. Great. Thank you for having me here. And, both Amelia and Florence already kind of set the floor for me, so that's great. So let's dive straight into it. Right. So my project looks at the US. And Florence already kind of alluded to it, but really in the United States, most of the focus by investors was really directed to the concept of business. How many boards overall directors sit on? There wasn't a lot of attention to the specific industries in which they serve and whether the directors overlap in the same industries. And this project was really an attempt to kind of examine the prevalence of horizontal directors, basically interlocking directors in the same industry, and examine it as a potential complementary or alternative channel to the concerns that the horizontal shareholding literature has raised, and I'm sure in the subsequent panels that will be discussed broadly. They also have some specific governance and antitrust questions. And as was already stated, I think the assumption was that because of Clayton Act, basically we shouldn't see any horizontal directors in the United States, right? There's like this prohibition about directors serving amongst competitors, and some of the academic studies that have been done just took it for granted. And the reality is that that's simply not the case. Today I'm going to show you a little bit of that empirical findings. I have a paper that came out a year and a half ago, and had data until 2016, and for this conference I updated the data all the way to 2019, and I'm glad to say, or I'm happy to say, that the results remain similarly concerning. So I'm also gonna, if I have time, I'll just show you a little bit of upcoming research that's supposed to kind of build on that our work. So regarding the data on horizontal directors, I have data on the S&P 1500 all the way from 2007 to 2019. So I added 6 years for this presentation. And the broad observations that I find is that horizontal directors still account for a non-trivial number of directors among companies. The numbers are still increasing over time, and some industries are more likely to have horizontal directors than others, which is also could be potentially concerning. This is just a sheer number of directors serving on the same industry, broadly defined, and you can see that the numbers are still rising, going up from 37 to 38% in 2016-17, and kind of similarly trending up over the number of boards you serve. So a director that serves on 3 boards in 2019, 65% of them served at least in 2 companies in the same industry. Looking a little bit more refinedly, looking at the 4-digit SAC and 4-digit NAICS, we can see that those numbers are still pretty concerning, right? Around 10% or close to 11% of the directors that serve on more than 1 board served in companies that in the same 4-digit SAC code, and similar figures for NICS. If we look at the time trend, you can see really that the time trend is still going up. My data for the previous project ended in 2016, so I'm highlighting kind of like the difference from 16 to 17, and you see that the rise has continued, kind of a little plateaued over time, but still significant numbers here as far as the prevalence of horizontal directors, both on the SAC and NICS classifications. So how can we explain the findings in light of Section 8, right? We have this requirement in the United States, you can serve on 2 competitors. How do I find that there's still horizontal directors? And there's a few things. First of all, the key here is how do you find competitors? And the way antitrust law deals with it is really a little bit different than looking at the same industry. You need to show that those companies really compete. So that's one explanation, but I found it a little bit unpersuasive. And part of it is because that definition really has some gray zone. How do you really capture that competitor essence? And as I saw in my work, the enforcement is really not much there. And when you talk to companies, you seem to hear this notion that they don't really respect that prohibition the way they should do. So that ignoring those restrictions because of lack of any tooth and enforcement to potential violation of Section 8. So combination of murkiness as far as what falls into this competition prohibition and then kind of lack of enforcement allow this to fester amongst public companies in the United States. I do want to highlight future work that I've been working on the last couple of years with 2 co-authors, Offer Eldar and James Pennington from Duke, really kind of trying to further pin down that relationship between horizontal directors and common ownership. That's something that, as was alluded in the beginning, is of particularly growing interest. And what we do right now, we have a sample of firms from 2014. We're increasing it to going further hopefully until 2019. And we look at the SAC 3 group and really look at peer year observations to kind of see if there is a presence of a director that serves on 2 companies in the same SAC code. And we look at the various measures of common ownership, including count and 13F data. And one of the key big findings here that even controlling for pair and year fixed effect, we see significant positive relationship between the number of common owners and the likelihood of having an interlocking director in the same SAC 3 group. A second thing that we try to look at is really kind of like trying to kind of get into the causal relationship, or kind of like what happens, what brings one to the other. And we do this dynamic study to look at how the addition of common owners impacts the likelihood of adding an interlocking director. And again, the results are pretty interesting. You can see here that there isn't really a evidence of a pre-trend in adding horizontal directors before a bill builds up this critical mass of common owners. And once that, but there is a relationship once the addition of common owners adds to an increased likelihood of adding a common director, and that is not something that continues after. So we can see that the effect appears permanent, it doesn't regress later on, and it's something that is very interesting to pin down more. We are working on adding more robustness to those findings and kind of looking at some other things that could be interesting. So we welcome any input people have on what they would like to see more on that respect. So with that, I'm going to end. Just to conclude, I think the United States presents an interesting question, especially for those of you in the EU. How do you tailor the restrictions in a way that would actually prevent horizontal directors from taking place? I think the US is a good example of how the law doesn't really prohibit or doesn't effectively prohibit the presence of horizontal directors. And that's an interesting thing to think about if the EU is to adopt something similar.
Thank you very much, Yaron.
Sorry for the intervention. I would just a quick reminder for the speakers, please don't forget to turn on your camera during your speeches so we can also see you. Thank you.
Thank you very much. Sorry, I should probably have said the same thing. Okay, so thank you very much, Yaron. And that was a very good reminder of the fact that just because there's a law doesn't necessarily mean it has its full enforcement effect. And also a start of thinking about the interaction between interlocking directorates and common ownership, which is something that José Azar will come back to in this talk after this. But first of all, we're going to hear from Chiara Picciau and on the particular situation in Italy, where they have in fact been banned in the banking sector. So one can start to look at what the empirical implications are in that situation. Chiara is an academic fellow at Bocconi University, and I'll hand over now. And yeah, put your camera on if it's working.
Can you hear me?
Yes.
Okay. I think I managed to share the slides and to turn my camera on, but I'm not sure whether you can actually see me.
We have your slides, but not your face. But it's
you have my slides, though, right?
That's the most important thing.
Okay. So, well, first of all, thank you for having me here. It is a great pleasure. Today, I will be presenting the results of an empirical analysis that my colleague Federico Ghezzi and I have been carrying out in the last few months on interlocking directorates in the Italian banking sector. As many of you know now, in 2011, Italy introduced a ban on interlocking directorates in the financial sector. One of the main reasons for this ban was a sector inquiry carried out in 2008 by the Italian Competition Authority. The inquiry examined personal and structural ties among companies operating within the Italian financial sector. More specifically, it focused on banks, insurance firms, and asset management companies. And it documented a wide network of structural connections, mainly minority shareholdings and interlocking directorates among competing financial firms. After the financial crisis in 2011, the Italian lawmaker thought that the effects of the crisis had been particularly harsh in Italy due to poor competition in the financial sector. So one of the measures that were put in place to remedy this was the interlocking ban. The ban has a pretty wide scope of application. It prohibits members of the board of directors and of the internal control body, as well as top managers of banking, insurance, and financial companies to hold any such office in any competing company or group of companies. For instance, the same person cannot serve as director of two competing banking companies, but the same person cannot even serve as director of, say, a leasing company and an insurance company belonging to different groups, if the two groups can be considered competing groups because, for instance, they each have a bank competing in the same product or geographic markets. Arguably, in this last situation, there is limited or no danger to competition, but the Italian interlocking ban still applies. However, implementation guidelines have introduced some targeted exceptions for interlockings involving very small firms. Once the Italian ban applies, the interlocker must opt for one of the incompatible offices within 90 days from appointment. If she does not do so, the interlocker is removed from all offices by the companies in which she serves. And if the companies do not intervene, then removal is enforced or should be enforced by the competent regulatory authority. So before 2011, several studies confirmed the existence of a wide network of interlocking directorates and minority shareholdings among Italian listed companies, which included many financial companies. It is significant that at the center of this network were Mediobanca, a prominent Italian bank, and Generali, an insurance company. Surprisingly, however, according to some studies, personal ties persisted even after the ban. For instance, according to a study carried out by Drago, Ricciuti, and Santella on listed companies, the ban led to a reduction in interlocking directorates, but the most relevant and central connections in the network actually persisted even after the ban. A similar result was reached in 2015 by Creatini and Main. The two authors of this study tried to replicate the Italian Competition Authority's sector inquiry using 2015 data. The result of their study was that personal connections among previously interlocked companies decreased in number but did not disappear. So their conclusion was that the ban had been somewhat ineffective. The possible reasons for this ineffectiveness could have been different. For instance, one could think that the chosen enforcement mechanism was the cause, since it relied first and foremost on the willingness of the interlocker to declare that she held incompatible offices, and on the willingness of companies to investigate these situations if the declaration had not been made. So this is the context in which the idea for our empirical analysis came up. Federico Ghezzi and I noted that these studies focused on listed companies generally, or did not fully take into account the scope of application of the interlocking ban. For instance, in the Creatini and Main study, they used a very broad notion of competition, even broader than the notion that it's used by the Italian interlocking ban. So, in our opinion, these studies could not reach reliable conclusions on the effectiveness of the ban, and we decided to conduct our own research on the subject. For now, our empirical analysis is limited to the banking sector. We are extending it to the insurance sector, but we're still collecting the data, so the results that I'm going to present here only concern the Italian banking sector. Our sample consists of the first 25 banking groups by size operating in Italy at the end of 2010, 2012, and 2018. They represent more than 90% of the market, both in terms of assets and bank branches in all years considered. So the sample is pretty representative, and it's fair to assume that the banks and banking groups involved compete in at least some product and geographic markets. For all years considered, we tried to determine the number of prohibited interlockings using the same notion of competition and competitor that the interlocking ban uses. More specifically, for 2010, we tried to determine the number of interlocking directorates that would have been covered by the ban if the ban had been enforced. This gives us some indication of how many interlockers in the banking sector presumably had to step down when the ban came into force. For 2012 and 2018, we essentially tried to determine if any interlocking that was prohibited according to the ban actually persisted. So with respect to 2010, our result confirmed the fact that interlockings were a widespread phenomenon with potential anti-competitive effects. While the number of interlockings was not as high as expected, probably also due to the fact that, unlike other studies, we did not consider interlockings within the same group, the their anti-competitive effects were likely relevant because we found that personal ties directly linked many of the main players of the Italian banking sector. So the total number of relevant interlockings we found in 2010 was 24. And in the picture here, you can see that many of the banking groups in our sample shared at least one, if not more, many more connections. More surprisingly, however, at least if one compares our results with previous studies, is our finding that at the end of 2012 and 2018, prohibited interlocking directorates among the 25 banking groups in our sample were 0. So at least within the Italian banking sector, the ban appears to have been effective, perhaps despite its unusual enforcement mechanism. With our data, we were also able to corroborate a tendency that had already been observed in the Italian banking sector, which is its increasing concentration. Our data show, for instance, that while in 2010, the number of banks belonging to the first 25 banking groups was 130, in 2018, this number decreased to 58. And similarly, the total number of positions available as director, member of control body, or general manager fell by more than 50% in the period considered. So if the interlocking ban has actually severed personal ties among competing banking companies, we should expect more competition in the Italian banking sector. As you all know, this is very difficult to test in practice. However, a recent study by Barone Schivardi and Sette seems to have overcome the obstacle and to confirm the pro-competitive effect of the interlocking ban within the Italian banking sector. They found that interest rates applied by previously interlocked banks dropped between 10 to 30 basis points vis-a-vis other credit relationships, which seems to indicate more vigorous competition. So there is at least some preliminary evidence that interlocking bans may have pro-competitive effects. So if this is the case, I would like to leave you with two final questions that I think should be addressed when considering to introduce an interlocking ban. The first is, should the regulator consider the level of concentration in the market when introducing a ban of this sort? Arguably, even fewer personal connections may have significant anti-competitive effects if the market is concentrated enough. And the second is, do we really need cross-sectoral bans like the one we have in Italy? Recall that the Italian ban would also apply between an insurance firm and a leasing firm belonging to groups that compete, say, in the banking sector through their subsidiaries. The risk here is to limit companies' choices with respect to key governance roles with limited or no benefits for competition. So, and with these two final questions, I have concluded, and thank you very much for your attention.
Thank you very, very much, Chiara. Some really nice analysis there and some good questions for taking forward into the policy discussion. If we now move to José Azar, Assistant Professor at the University of Navarra. Many people on this conference will previously have heard of José's work because he's done a huge amount on common ownership, and indeed his papers were mentioned twice earlier by Ioannis. And indeed his work helped kick off the whole debate that we're having today. But actually, he's maybe less well known for his work on interlocking directorates, which we were reading his PhD and found. So we persuaded him to bring it out of his PhD and onto the screen today. And it again takes forward this idea that Yaron introduced about the intersection between common ownership and interlocking directorates. Thank you. Take the floor.
Thank you. So, yes, Amelia invited me to this panel, I think, because she found a chapter of my thesis called Common Shareholders and Interlocking Directors, the relation between two corporate networks. It was chapter 5 of my thesis, in which I was trying to see if there was a correlation between a pair of firms having common ownership, that is interlocking shareholders, and common directors, interlocking directors. And my motivation for doing that was because a lot of people were asking, when I was doing my thesis, which was mainly on common ownership, whether these shareholders had seats on the board. And generally the answer was no, they don't have seats on the board. And the reason is they file as passive shareholders, even though in corporate governance, even they argue they're not completely passive, but their filings are not 13D filings, they're 13G filings. And if they appointed explicitly board members, they would have explicit seats on the board. They would say, well, this board member is our board member, like you could say in the 19th century, JP Morgan would appoint people for the boards of the companies in which he had a common ownership in. But in the present, or in 2011 and 2012, which is when I was working on this, that couldn't be done. I mean, it would be, from a regulatory point of view, too burdensome for them to appoint directors to the board. So I was trying to see if we could find some footprints of the shareholders which had the votes. So maybe they influenced who got nominated for the boards, but obviously this was not explicit. So maybe an implication of that theory is, well, maybe we should see a correlation between common shareholders and common directors. We would see that companies tend to have more directors in the same of the same community, and therefore more likely to have an interlock if they have a similar shareholder. So I was also doing some reading of sociologists who had worked on the issue of interlocking directors for a long time. Especially, there was a book by Bill Domhoff from 1967 called Who Rules America, and it was very influential, that literature. And today, I think it's almost, it's so ingrained in the culture, this idea of like people worry about conflicts of interest. He was so interested not just in interlocking directors between companies, but also in what he called the corporate community, which he said was characterized by interlocks between companies, but also think tanks, foundations, and the government, as well as academia. And sociologists have been since then, or even before then probably, in mapping this corporate community and the possible conflicts of interest that it can generate. And today people are obsessed about things like the revolving door and things like this. So this it's already a part of our culture, right? It's a book that was done more than 50 years ago. So this was a graph that I did in chapter 4. So in the previous chapter of my thesis, which was trying to see what the shareholder network was looking like in 2010. And you see these big clusters, which were Fidelity and BlackRock, right? Here and here. This is BlackRock and this is Fidelity, and there's other big asset managers that create clusters of firms. This network here is defined as two firms being linked if they have a common shareholder at 5%, that has 5% in both at least. And back then, not all the companies were connected at 5%. Today, probably the cluster would include all the companies. And the reason is, at this point, BlackRock and Vanguard in the US have more than 5% of essentially every publicly traded firm. In chapter 5, I did some graphs of the directors network using data from the corporate library, which I don't have access to anymore. So I'm going to try to update this chapter for publication in the Journal of Competition Law and Economics, and I will have to use a different data set that I have now, which is ExecuComp. It has a slightly smaller set of firms, but I think it will probably be just as good. So this is a network of around 2,600 firms in the US, and two firms are linked here if they have a common director. And to me, it seemed really interesting that, yeah, almost all of the firms are connected in the network to some extent. Of course, not all firms are connected with all firms, but you can draw a path to get from almost any firm to almost any firm. These are indirect connections. And the larger firms are more connected. So they're at the center of the network, right? You can see here the color of the circles indicates the number of connections that the firms have, and the size of the circles is proportional to the log of market capitalization, so firm size. And we can see that there's some sort of kind of a nucleus or of very highly connected and of firms, and those tend to be the largest firms. And then the smaller firms tend to kind of gravitate around the larger firms. So that's my attempt to draw the corporate community in 2010 for the US. And then the question was, well, can we say something about whether they are related to the common ownership, right? These director links. So one thing that was clear is, well, that the larger firms have more interlocking directors, right? And larger firms have lower network distance. So it's easier to get from one large firm to another large firm than to get from a small firm to another small firm in the network. So I estimated this, what I call gravity equations, just in mimicking, the work on gravity equations in the international trade literature. Here, instead of GDP, is market cap, the size, and geographic distance. And basically, firms that are closer in geographic distance terms are more likely to have a common director. And larger firms, as we said, are more likely to have a common director. That's not true necessarily for common shareholders. So that doesn't necessarily drive a correlation between the two. Also, firms that are in the same industry at the 3-digit SIC level are more likely to have a common director, which was surprising given what Yaron was saying about the Clayton Act Section 8 prohibiting competitors from having interlocking directors. But SIC 3-digit, is very broad and probably is not enforced at that level, but at a much more narrowly defined market. And being in the S&P 500 is also predictive of common directors. Okay. So one question that I was trying to say something about was, how do we measure common ownership? And in this part of my thesis, I came up with some measures that I thought were somewhat intuitive, and I was trying to think about, well, how do we come up with a better measure than 5%, a 5% threshold? So the first measure I used was a dummy, which is one if the firms have at least one shareholder with at least 5% in each firm, which was what a lot of the literature was using. But also, well, can we say something? Can we come up with a continuous measure? And one continuous measure is this maximin, which says what is the highest threshold that the firm would pass, right? Say if a firm has two shareholders with 8% in each firm, it has more common ownership than a firm that only has 5% in each firm. And so if you do the maximum across all the shareholders of the minimum between the share in firm J and the share in firm K, you're going to come up essentially with the answer to that question. So it's going to say a firm that has a shareholder with 50% in both firms has 50% in the measure, and one with a shareholder with 1% in each firm at the most has 1%. So the other one has 50 times more common ownership than the latter. Another measure is the inner product of the shares. So this is the sum across all the shareholders of the share that they have in firm J times the share that they have in firm K. And this can be interpreted as a weighted average of how much, of what's the average share in firm K that the average shareholder weighted by shares of firm J has, right? So it's how much ownership of firm K do the shareholders of firm J have, right? So I would interpret this as a weighted average share of the competing firm. And I also proposed another measure, which was a sum of means. I didn't include it here because I wanted to keep this short, but it's basically summing the minimums instead of taking the max in two, and saying essentially, if you have one shareholder that has 5% in each firm and you have another one that has 3% in each firm, then the sum of the means would say you have 8% of common ownership, whereas the maximum is going to tell you have 5%. And a measure that I didn't use in this chapter, but I hope I can use when I rewrite it for the journal, is the lambda. And I introduced this in chapter 7. So at the end of the thesis, I was thinking more about this, and I thought of, well, another measure of common ownership, which is very related to the work of O'Brien and Salop, which is the lambda, right? Recent work by Bacchus, Conlon, and Sinkinson also put a lot of emphasis on this measure. This measure is interesting because it's more than intuitive. It has an economic interpretation. And basically, if shareholders maximize the weighted average of shareholder if firms maximize the weighted average of shareholder profits, then this is going to be the weight that firm J puts on the profits of firm K relative to its own profits. So basically, if a firm is maximizing the sum, let's say, weighted in this way of the shareholder profits,
Jose, I need to warn you, you've only got a couple of minutes left, maximum.
Okay.
It's very nice drawing.
Okay. So, all right. That's it. Okay, so if you have this as the objective function of the firm, and this could be microfounded with a voting model, then under some assumptions, such as that the shareholders are risk neutral, then this would be economically meaningful. All right, so then basically, and that's it. So I need just now 2 more minutes. So basically, using these measures in a gravity equation for the probability that the firms will have a common director, that a pair of firms has a common director. So these revisions are at the firm pair level. So that's why we have 21 million observations. Or having the log of the distance in the network of directors as an alternative dependent variable. There is a correlation, even controlling for the log of the product of firm sizes or geographic distance and so on, and firm pair fixed effects. There is a correlation between having common shareholders and common directors, or being close in the network of directors. So, and that's basically where the chapter ended. I mean, I interpret this as suggestive evidence that shareholders influence board appointments, even if they don't have directly board seats. But this doesn't really answer the causality question. So I think that Yaron's work is definitely going more than a step further here in saying, well, is it really the shareholders that are appointing directors, or is it just that the firms are similar in some way, and that's why they both have common shareholders and common directors?
Thank you very much, Jose. That was some further very interesting interaction between the two issues of common shareholders and interlocking directors. So I now would like to ask Tommaso Valletti, Professor of Imperial College London, to provide a policy perspective on this area. You'll probably all know Tommaso. He was chief economist at DG Competition. He's an extremely smart commentator with very robust views. He's also a co-editor at the Journal of Competition Law and Economics with us. So, Tommaso.
Thank you, Amelia, and thank you very much for having me on this panel. So I will give you just some comments. You saw some great presentations by Chiara, Yaron, Florence, and Jose. Would you see there is great research which is being done? It's rather a pervasive phenomenon. We're learning about plausible mechanisms. This session was about interlocking directors. What's interesting is also that many economists and others are trying to measure things. So we are becoming more precise. And as we measure things, we're also obtaining some effects in the markets which are being affected. So that's all very interesting. I have 2 sets of comments, one more for the academics and one more for the policymakers. So for the academics, what's interesting in this field is that the researchers are borrowing from a variety of fields. You have scholars in law, in economics, in particular industrial organization, in finance, but also in network analysis. So the presentation of Jose, for instance, was based on tools that that people were working on in organization theory and sociology many years ago. So that's fantastic. A warning, if I might say, to my academic colleagues is that try to be, how can I put it, tolerant with each other, precisely because it's research across different fields. Open-minded, appreciate the virtues of methods and approaches used in other fields as well. So I know that in academia, in order to publish well, the bar is very high, but if we have to satisfy jointly the bars in every field, then this research will take ages to be published, okay? And then it may be too late to affect the thinking of policymakers. So specifically, since I do come from industrial organization, which has a very peculiar approach to things, if we think that we should build a realistic model, a structural model of product market competition under common ownership that also feature governance frictions, endogenous ownership structures, and perhaps even endogenous asset prices. I mean, this is a research agenda for the next 20 years, and results will be published not in finite time, and it will be too late. So I would hope that people understand that the topic is great. It is, happening, and we need to provide some advice to policymakers. Okay? So keep doing scholarship, but also understand that there is a real world out there that needs some practical advice. So as you write the papers, try also to think how to help the policymakers, which is the second set of observations, according to my limited experience. I worked for policy as an enforcer only for 3 years. Policymakers, most of them are curious, so they will be following what you do with great interest, but policymakers also act on precedents, okay? And to change the status quo, to change the way they operate, it takes really a big effort. You have to help them, because currently they don't know what to do with these figures and with this data you're coming out with. They don't know. So I had lunch before the lockdown in London 2 months ago with Andrea Coscelli, who's the chief executive of the CMA, an economist, PhD Stanford, extremely enlightened, and is so interested in what's going on. But when I was asking him, what do you do with respect to common ownership, he said, but we don't collect this info. And even if you give us lots of information about BlackRock owning 4%, what do we do with it? So this is what they always struggle with, what to do with it, okay? They don't collect, policymakers, in particular competition authorities, and speaking to competition authorities, I know much less about financial markets, but competition authorities do not collect data about common owners. They don't collect data about directors and so forth. They don't have that information. So my concern, there was a big roundtable at the OECD, I think last year. And the bottom line, after lots of talking and the actions that the OECD decided to take was, let's perhaps collect more information and then let's reconvene. So, and this is not good enough, because this means that, again, that we are not pushing the bar to help the policymakers do something in practice. Personally, I tried to use common ownership when we were investigating at DG Comp, Dow DuPont and Bayer Monsanto. So those were two big cases where we looked into it, but they remained the two only cases. Okay, and they were used as I think, if I remember correctly, as an element of context of how the industry could work, but they didn't inform the merger assessment per se. And actually, the Deputy Director General for Mergers, which at the time was Carles Esteve-Mosse, was very clear, because people in the profession, these are the competition lawyers, these are the big law firms, etc., were horrified by this new venture into something they had never heard of, common ownership. It was very clear to say, don't read much into it. Okay, we are not going to assess common ownership again unless in special circumstance. Everything is a case by case, and in fact, things stop there de facto. Okay, so we haven't made much progress in cases for the past after that little window of opportunity. Also, talking from an European perspective, Dow DuPont came in 2017 and Bayer Monsanto in 2018. And the Commission had, in a sense, cornered itself, because it had just issued at the end of 2016 a study on cross-minority shareholdings, which is different from common ownership, but the economics is not that different. And basically, after this big study, they concluded our law is already up to the challenge. We don't have to change anything. And that basically meant business as usual. The Commission, and there's another panel with representative for the Commission that obviously will tell you something different, but also commissioned a study on common ownership done by the JRC, the Joint Research Center. That's not DG Comp. And basically they buried all the considerations about common ownership for real cases with a study that then concludes more research needs to be done, which means that for practical cases, we haven't raised the bar, or we haven't helped much the enforcers to make progress in practice. My little suggestion back then, again, to the commission was, okay, we don't have that information, but let's do something that will not involve a lot of resources from the authorities. So let's ask firms anytime there's a big merger, let's ask them in some forms which exist. Tell us who your biggest financial positions are, the biggest owners are, etc., etc. So at least they tell you. So this is a low-cost way of attracting information. But even changing that became an obstacle to any change. And so I haven't seen any change whatsoever. I'm sure there is exception in the world. I'm sure that perhaps the Hellenic Competition Authority is already at the forefront of these new ideas. But the practice of antitrust enforcement hasn't changed a lot. So let's reflect as a community of academics also, if we think this is a big problem, I think it is, okay? It's something we should be doing something about. We have to help the enforcers also to make progress into how to incorporate these findings into the way they think and operate. Thanks a lot.
Thanks very much, Tommaso. So we've heard quite a lot of the academic work in this space. We've also heard from Tommaso that policy discussions are ongoing, but that real policy change can be slow. But at the same time, if we wait for the academic literature to get right through the whole process of academic publication and to really prove the case, we may be a long way down the line and we may lose out on a whole bunch of consumer benefits. So maybe we do need to be thinking about policy sooner rather than later. The third panel today is all about the policy implications, but I didn't want to let the academics on this panel go without just asking them whether any of them wanted to highlight what they felt the policy implications, particularly in this space, so the interlocking directorates, were on the basis of either their work or the other work in this space. Would anyone like to make a comment? Don't be shy. Chiara?
Yes, here I am. I just have a brief observation following up on our study. Well, I think the main implication of our work is that the desirability of ex-ante prohibitions on interlockings, like the one we have in Italy, also depends on market-specific conditions that must be corroborated empirically. Ex-ante bans are not the only solution, and competition authorities could also intervene with ex-post measures aimed at severing structural and personal connections when reductions in competition have already been observed. So I think circumstances such as the pervasiveness of the phenomenon, the history of collusive behavior in the market, or the level of concentration in the market, and the existence of significant levels of regulation and regulatory barriers may all weigh in favor of ex-ante prohibition. And these are all circumstances that we observed with respect to the Italian banking sector.
Thank you. So an argument for at least sector-specific or market-specific bans in certain circumstances. Yaron, did you want to come in?
Yeah, there's one thing that didn't come through when I talked about interlocking. I think is important to note is that there are some valuable attributes of directors who serve on multiple companies. So we need to be careful from a policy perspective not to kind of overkill, in the sense that directors who serve on multiple companies, even in the same industry, can bring some valuable information. The research on networks that José highlighted, and there's a lot of growing literature on that. There are some valuable aspects of sharing a director, even across an industry. So when you tailor a prohibition, really there's a need to balance between the concerns of potential antitrust violations with the benefits from a governance perspective that they can bring to the table. So that's something that I try to kind of balance in my work, and I just want to encourage everybody to be aware of and try to kind of also incorporate it. And when they suggest reforms in the EU, it's not a one-size-fits-all type of solution.
Thanks. It's really a good point always to highlight the kind of the benefits of these sorts of things as well. Florence, would you like to come in?
so thank you very much for this presentation. So indeed, I think it's interesting to think about the fact that appointing board members seem to be at the core of the freedom of corporations to organize as they see fit, and indeed appointing individuals is very critical, perhaps. But also I would like to reflect on the concept of competitors. So now we see that maybe we should understand competitors in a quite narrow way, otherwise we may have too intrusive prohibitions. But at the same time, with digital markets, it's difficult to think about who is competing with whom. And I think Eric Schmidt, when he stepped down from Apple's board, is that at a certain point it became apparent that Google and Apple had become within what we think as competitors. So at the same time, we need to be cautious of not being too intrusive and interfering with the freedom of companies to appoint their board members. But at the same time, we need also to think and factor in how markets do evolve, and how, if we ever introduce a ban, how do we make sure that it's fit with evolution of the economy? Thank you.
Thank you. And that the Google and Apple example is a really interesting one, because I guess who your competitors are may vary through time, and your strategic competitors are kind of across your ecosystem of business of markets may be somewhat different to your kind of very precise product specific competitors. I guess that's probably true in Italian banking as well. José, would you like to come in?
Yes, so I don't really have a policy recommendation on interlocking directors, because I was seeing this more from the common ownership angle, as a test of that theory. I would like to comment a bit on Tommaso's insights. I'm very reluctant to make. I'm becoming more and more reluctant to make some sort of antitrust policy recommendation of breaking up the common owners and so on. Although this should definitely be on the table. It's just that the more I study the subject, the more complex I realize it is. And here's the thing. I mean, I came to this as saying, well, the finance people and corporate governance are really missing the antitrust angle. But also, as antitrust people, we don't want to miss the corporate governance and the macroeconomic angles of this. And this is very complex, because these are retirement plans and things like this, which is something that BlackRock in their reports and so on like to point out when they criticize the common ownership literature, but it's true, and it's something that makes policy on this very complicated, and also the fact that there will be some pro-competitive or benefits from common ownership. I mean, I still believe common ownership is very dangerous, and we need to monitor it and perhaps break it up. I think this is easier said than done, and this is why probably the policymakers that Tommaso is talking with don't know what to do with this literature, because it's not a literature that leads to easy policy recommendations. In that sense, it's not something where economists can really say, look at this great policy proposal that we have that could solve this problem. I mean, it's much more political economy, and it's retirees, workers, and consumers all involved, and also billionaires, but not all investors are billionaires. So yeah, I think it's very complex, and I don't expect anything to be done in the near future. In terms of breaking them up, I think in terms of measuring common ownership in the context of a particular merger or things like that, definitely things can be done, and I'm working on that with Anna Tsanaki. But in terms of a big breakup of the big three, which could happen because they may become so large that it really becomes obviously threatening to the economy, but it will be very hard to do, I think.
Thank you very much, José. I think I should stop us now. There'll be more policy discussion, and indeed we're going to hear your co-author Anna Tsanaki in the next session as well. So I would just like to finish by thanking José, Chiara, Yaron, Florence, and Tommaso. I think that was a really, really good panel to kick us off. We have a 10-minute break now, and we're going to start again at 3:30 UK time, 4:30 CET, for a session that is fully on common ownership. Thank you very, very much, and see you later.
Thank you, Dr. Fletcher, and many thanks to all speakers of the first panel for so effectively exploring the key antitrust aspects of interlocking directorates. Let's take a short break and reconvene again at 3:30 p.m. GMT. Please join us after the break. Welcome back to the JCLE Conference on Common Ownership, Interlocking Directorates, and Competition. We will now move into the topic of common ownership to be discussed by the second panel. The second panel is moderated by Dr. Martin Peitz. Dr. Peitz is Professor of Economics at the University of Mannheim and a Director of the Mannheim Center for Competition and Innovation. Mr. Peitz, Dr. Peitz, welcome. You have the floor.
Thank you very much. Welcome to the second panel of this conference. I'm very happy to have a set of active, energetic speakers today talking about various aspects of common ownership. And we will hopefully have time for some discussion at the end, and to make some time for that, it's best to start directly with the first speaker, José Seldeslachts, who will talk about common ownership in European banks. Joe is a faculty member at KU Leuven and a senior research fellow at the DIW Berlin. And his work focuses on competition effects of mergers, state aid, and common ownership. He is currently involved in reports for the Director of Competition at the European Commission and a report for the Dutch government. Joe will be joined by Albert Banal-Estanol, who will remain silent for the presentation, but hopefully joins us for the discussion, who is Associate Professor at University Pompeu Fabra, affiliated Professor at City University London, and his research focuses on competition policy and corporate finance. Joe, the floor is yours.
Thanks for the introduction, Martin, and thanks for having us on this conference. Let me share my screen. So this is joint work with Nili and Albert Banal-Estanol, who is also, as Martin said, on this panel. This is a spin-off of a recent project we did for the European Parliament. It's gotten a bit further away from that, so this is still very much a work in progress. The basic idea of this work is to look at common ownership patterns in European banks. Specifically, we look at the top 25 European banks, and we want to compare what happens in terms of patterns pre versus post Great Financial Crisis, at the financial crisis of the years around 2008, 2009. We focus on two groups. One is the common investors, which mainly includes investment managers, such as the usual suspects as BlackRock and Vanguard. But we also focus on the non-common investors, and these are usually local governments, individuals, and corporations. So this is a very European project, if you want, and this is in contrast to most of the studies that are out there that focus on the US industries. And there's also one study by José, Azar, who we've seen before, that focuses on US banks. So we want to highlight the differences between Europe and the US. This is our sample of banks. On the left-hand side, you see our 25 European banks. For several reasons, we have included also UK banks, Swiss banks, and Norwegian banks. And on the right-hand side, you see our sample of US banks. Now, you may ask why 25 European versus 10 US banks? Well, it turns out number 25 in Europe, Swedbank, in terms of assets, is roughly equal to the number 10 in the US Capital One. So that's the reason why we compared more European banks to US banks. And the first table I'm showing here is focusing on the top 15 investors ranked by the number of block holdings defined by having a higher percentage than 1% in one of the European top banks. There's of course several thresholds one can choose, but we chose 1%. I highlighted here already in red the ones I want you to focus on. On the left-hand side, we have pre-crisis, so the 2007 quarter one. On the right-hand side of the table, we have post-crisis, 2010 quarter one. Now, pre-crisis, we see as a top 3 capital group with 15 block holdings, Aviva with 6 block holdings, and M&G Investments with 5 block holdings. If we then go to post-crisis, it's the Norwegian Sovereign Wealth Fund, NBIM, who got out of nowhere to top number 1 with 17 block holdings. BlackRock the same, really came up post-crisis with 12 block holdings, and Capital Group is still there with 10. So conclusion, the number of block holdings of the top holders clearly increases with specific the Norwegian Sovereign Wealth Fund and BlackRock. Now, if we then look at the completely different side of ownership, looking at who holds the top position in those banks and by how much percentage. Again, we compare pre-crisis on the left-hand side with post-crisis on the right-hand side. So focusing on the top 3, in pre-crisis, this was SAS Rue La Beauté with 55% holding in one French bank, Government of Norway with 34%, and then CEA, a Belgian bank, with 27%. If we go then post-crisis, what do we see? The top holder is Cajas de Ahorro de Pensiones de Barcelona, and it holds 80% of a Spanish bank, UK Financial Investment, which is the UK government, 70% in the British bank, and SAS Rue La Beauté 55%. So clearly, the top holdings have moved up post-crisis. I also highlighted in red the governments. Pre-crisis, there was the government of Norway and the government of Sweden. Post-crisis, you have twice the UK government on number 2 and number 4. You have again the government of Norway and government of Germany and government of Sweden. So another pattern we see, some governments post-crisis take quite large stakes in the top banks. If we generalize this now and focusing on our whole sample, and we divide the type of investors by investment managers, that's the green line, government agencies and individual and corporations. If you look at the left-hand side picture, which shows the number of block holdings again, you clearly see that investment managers by far hold the most block holdings, and this increases by the end of our sample. On the other hand, if you look again for our whole sample, who's the top holder and what's the average percentage there? Here it's the government agencies that have by far the highest stake, especially in the beginning. This rises post-crisis. Individual corporations, they rise towards the end of our sample, and they get more or less to the same point of government. On the other hand, investment managers, in terms of having the top position and the share they held, are clearly much lower. On the other hand, so another picture is what people want to see sometimes is if you look at, let's just count the total shareholdings, like 100% of each bank, and see what is the share in each bank, what divided by type of investor. And here you see again that it's the investment managers who hold across our sample more than the majority on average. Governments and individuals much less. But here again, you see this bump of governments. Now it's maybe the moment to compare this to what we see in US banks. The picture is completely different. Here is the total share in US banks is 100% owned by investment managers, and of course, in turn, nothing by individual corporations. So clearly in Europe, the picture is very different than it is in the US. So these are the average pattern. Just let me point out also that within Europe, there's clearly different groups and different patterns. One example, I show each one example. BBVA, clearly this is a bank where you see the rise of investment managers. You see here again BlackRock and the Norwegian sovereign wealth fund. Then there's another example where it's the government that comes in very strongly after the crisis, the Royal Bank of Scotland, at 70% of the UK government. One group that we don't see really in the average pattern, but it's quite striking, Nordea, which is a Scandinavian bank. You see both pre and post crisis that local Scandinavian investors keep on dominating the charts there. And then just again to contrast this with American banks, as an example, Bank of America, both before and after the crisis, it's the usual suspects, if you want, such as Barclays taken over then by BlackRock, Fidelity, State Street, and so on. So what are the takeaways of our ongoing study? So clearly, the stake of common investors remains large in Europe as a percentage of total, but still there are some interesting patterns to distinguish post-crisis, and you see for both common and non-common investors that they gain in importance. On the one hand, investment managers seem to widen their common ownership network. On the other hand, governments, individuals, and corporations, typically non-common investors, they increase their individual stakes as top investors. Just to contrast this with the US, in the US, it's completely dominated by the typical investment managers who are also always common investors. And thank you for your attention.
Thank you, Joe. So thanks for these very interesting observations regarding European banking and common ownership. This was clearly, mostly, I guess, at least horizontal, and we also observe common ownership in vertically related markets, and that will be part of the second presentation by Anthony Medina, who is here together with Alina Velias. Both are PhD students at City University London, and they are about to finish. Congratulations. And their work focuses mostly on game theory and networks, and here we see an application to the issue of common ownership. The floor is yours.
Thank you very much. Let me just get the technology working, and then we'll be set to go. Okay, right, so good afternoon. So obviously, thanks for the introduction. So common ownership problems and these mechanisms of influence have been, obviously been studied quite a lot, but primarily on horizontal markets. But the influence in the vertical market is just as important, and the similar effects are noted. So Alina and I have been looking at this problem. There's a lot of empirical evidence about how common ownership across the vertical supply chain can affect competitive outcomes. There's also a lot of additional theory on the mechanisms of how investors who own various parts of the supply chain again will have an effect on the actions of the corporates. I'm not going to go too much into that literature, this was meant to be Alina's bit, so I'll just state that there's kind of a lot of empirical and theoretical literature, very similar to the horizontal literature, in about how a common ownership by investors may well be a problem to competitive outcomes. So adapting to looking at the vertical problem, the main metric that people have used to kind of analyze these issues has been the MHI delta, which unfortunately is all taken from the perspective of the companies. How much are they going to be influenced by various investors, and depending on their market shares, etc. But what when we want to apply to a vertical market, these measures don't really make any sense. And so we will try to coming up with ideas of how do we measure the investor influence on a market. And so, this just kind of an example on this presentation just shows that, in a retail market, you might have a market with very low concentrations in the companies and in terms of a broad investor base. But if you look at a supply market where its pricing outputs become inputs for the pricing in the retail market, dominant investors there can actually produce very anti-competitive effects in markets that, superficially at least in the horizontal level, look actually reasonably efficient. In this sort of toy example, we've got a couple of investors, a couple of companies in the retail sector, and we've got one big dominant investor in the supply sector. Now, just looking at the horizontal market and the retailers, you might conclude that nothing much was going on. I mean, if we had a few more investors and things, but the investor 3 is influencing further down the vertical chain is not captured by traditional measures. So we start looking at some other things. So one of the things that we wanted was to combine both a traditional network centrality measure with some of the methodology of the HHI, which has proved to be very popular because it's simple to calculate. It gives you some idea of the distribution of the market shares in one simple number. So we wanted to kind of have something that was, like that. Now, this is an example from, a simple 2 markets. I think this was an example used in the Azar paper when he was talking about this MHI delta problem. So in a horizontal markets, if you have 2 companies, 50% market share each, 2 investors own 100% of each of them. The reasoning from the theoretical literature is that this is actually a very good situation because both companies should compete pretty well. There were no cross interests. The companies are looking to maximize some kind of portfolio ownership effect. But one thing that we kind of came to observed was, although this was indeed true, what it didn't capture, these metrics, was actually how much influence these investors have on the corporate decision making of the actual companies. So in this situation, even though each company is owned by independent entities, they're both 100% owned. You'd imagine that their influence on the corporate behavior of these 2 companies would actually be very large. And so we needed a measure that kind of captured that. As investor percentage holdings of companies go up, we want this measure to go up as well. So we want to try and capture what it is we understand that means by control or influence by investors. And again, the second toy market, where now each company investor owns 50% of each of these companies, from the traditional MHI delta kind of reasoning, this is much worse situation. But from just if looking at perspective of the investors, actually they kind of each of them only really have half as much influence on each company. And so we'd kind of like that measure to reflect that, and the fact that their overall influence is now actually lower. So anyway, we kind of, these are the background to what we were looking at. And again, what we looked at was more centrality measures. So we're looking at the kind of the out centrality of the investor base. And this is a great idea because in one sense, we can get a good measure of how much all of the investors have an effect on the market by squaring their weights, their ownership levels, very similar to the methodology of the HHI. And so we come up with a new measure of the market, and it kind of measures very simply how much overall influence does the investor base have on the companies in that market. And so for each company, we calculate this, very kind of simple measure. Whereas, HHI delta is actually a very complex measure, trying to measure 3 or 4 separate effects. was this measures a very simple thing: how much influence, weighted by the percentage ownership, and it gives a kind of an idea of what it does. It's easy to calculate. It's also very linked to traditional centrality measures in network theory. It's very related to, in weighted networks, the participation ratio and node strength. So it's kind of got a very reasonably good kind of theoretical basis, and it's kind of quite easy to calculate on a horizontal market. But obviously we're interested more in the vertical market, and so we go back to our kind of simple example, and we immediately see the differences of what we can do. So here we have, as before, a retail market, so the end market, primary market, 2 companies, 2 investors, and there is in the supply market, 2 companies, 1 investor. If we just look at the first market, we've got 3 investors, 2 companies. It doesn't look too bad, but obviously it doesn't capture this dominant effect of investor 3 owning the supply chain, some part of that vertical supply chain. So we can apply the measure of this centrality measure for the investors across these various layers using a multi-layer network centrality metric, which again is a quite common and useful metric. And it really is simply looking at the contribution of each of these investor groups in each level, in each layer of the market, averaging over layers to get an overall measure of how much investors control or influence the entire supply chain. And in this way, in this little market here, if we calculate the traditional MHI delta measures, in the first market we have 5,000, second market we also have 5,000. And obviously we can't really apply it across the 2 dimensions because it doesn't kind of make sense, because the companies 1, 2, 3, and 4 are actually disconnected in that sense. They're only connected by the investors. But if we use our centrality measure from the perspective of the investors, we get a level of 1,600 for the first market. We get a very large level of 5,000 for the second market, which kind of reflects a kind of intuitive understanding of what it means to have influence. And there's an overall market. We get then a moderately high number of 3,000 odd. And in this way, we can capture the fact that certain investors may well own various important or influencing chunks down the supply chain. And if we look at the market as a whole, as a multi-layer network, we can use this which looks kind of a monstrous kind of formula, but actually, it's really just that very simple formula from the other page translated onto a multi-layer system and then averaging out. So this is kind of what we do. We're working with Ioannis and Alina and to apply this to some actual data. And we intend to do some very similar things to Azar in the airline and banking papers by testing on Greek supermarkets, for example, or some various other data sets, how ownership through the vertical supply chain affects pricing outputs in food retailing, particularly in Greece, because that's where we're going to hopefully have some very nice data. So unfortunately, we didn't get the data in time for this presentation, but we are hopeful it might show something quite interesting. I haven't
Anthony, thank you very much. Thank you. I think we're running out of time, so in a sense, it's rather fortunate that you don't have yet the data. So otherwise, we would have a severe time problem. So thanks for alerting us to the importance of these vertically related markets and trying to find measures of investor influence. What we move on next is trying to understand a bit what are the channels of influence. So what are the ways how common owners can actually intervene? And for this we have Nathan Shikita. He's a recent graduate from Yale School of Management, interested in antitrust, healthcare, and data analytics. And he has done something which is pretty rare. He has already published, and he hasn't just published somewhere, but he has published in the Journal of Political Economy. That's what many people in our profession strive to achieve at some point in life, and he actually essentially starts his life as working in academia with such a publication. But now we're moving to Nathan's presentation on interventions by common owners. The floor is yours.
Well, thanks very much, Martin, and hi, everyone. Let me share my screen right now. Okay, I'll start by thanking JCLE for giving me the opportunity to present my recent work on common ownership and participate in this fantastic panel. I know there's not much time, so I'll just get right into my paper, which is called Interventions by Common Owners. So just in terms of a really brief overview, common ownership has received substantial attention from scholars and policymakers in recent years. And a lot of this interest has been driven by new empirical market, industry, and macro-level evidence. I think one question that underlies much of this work and still hasn't quite been answered is the question of how common owners influence or affect firm decision-making. And in particular, what are the mechanisms that a common owner uses to influence portfolio firm behavior, and in what industries does this appear? So to expand more on this motivation, you can see engagement statistics from BlackRock, and this is from their annual stewardship report in 2019. They reported over 2,000 engagements with over 1,400 companies, reflecting 50% of assets under management in 42 different markets. And despite this very substantial reach, little evidence has been uncovered to reveal a common owner's selective use of corporate governance mechanisms. And so this is where my paper comes in. What I do is quite simple. I compile and taxonomize 30 cases of common owner intervention with examples strictly limited to what is in public domain. These cases come from media investigations, regulatory proceedings, policy group analysis, and stewardship reports. And in terms of the organization, I classify intervention under 3 very simple mechanisms. There's voice, executive compensation, and voting. And I further split into subcategories for both voice and voting. Based on the evidence I have uncovered, common owners may use these mechanisms to achieve a variety of objectives. They can induce collaboration, appoint favorable firm leadership, or influence ESG initiatives. And these interventions occur in many different industries, such as pharmaceuticals, oil and gas, and ride-hailing services. So I'll now briefly go over 2 examples that I've documented in the paper. The first involves a common owner's use of voice in the pharmaceutical industry in response to COVID-19. So in April, the Financial Times reported that large institutional investors, such as BlackRock, publicly told drug companies that they wanted them to put aside any qualms about collaborating with rivals. And other asset managers also wrote a letter asking firms to share any relevant findings on a vaccine, as well as draft enforcement of relevant patents. And so I find this example interesting for 2 reasons. The first is that common owners do not appear shy about using these calls to action when doing so would benefit their public perception. And the second is the resultant partnerships that we have since seen following these calls to action. So, for example, you might look at the partnership between Pfizer and BioNTech. And I'm certainly not claiming that these common owners are the sole driving force behind the collaborations, but you can certainly imagine that these statements, at the very least, reduced managerial uncertainty about forming a partnership in the first place. So moving on to a separate case that involves the use of voice and voting. SoftBank, as a common owner, has significant stakes in ride-hailing firms globally. In this case, I'll focus on their stake in Uber and Grab. And Grab is a ride-hailing firm in Southeast Asia. So in 2017, SoftBank took a 15% stake in Uber, as well as 2 seats on the company's board. SoftBank was already the largest shareholder of Grab at that time. And it was noted that Uber was fighting Grab for market share in Southeast Asia. So SoftBank founder Masayoshi Son made a number of interesting statements about the ride-hailing industry. Initially, he publicly stated that if management at Uber, Didi, or Grab were to talk with one another and come to an agreement, and in doing so raise shareholder value, we will study that. SoftBank executives also stated that one ride-hailing company will eventually dominate in each region, and they wouldn't mind more collaboration in the meantime. So, in March 2018, Uber perhaps unsurprisingly sold its ride-hailing business to Grab for a 27% stake in the company. At the time, Grab's only remaining competitor was a firm called Gojek. And just this year, shareholders asked SoftBank to bring an alliance between Grab and Gojek. So SoftBank, and in particular Masayoshi Son, visited Jakarta for exploratory discussions. And just a few days ago, and this is why I chose to use this example, it was reported that Grab and Gojek were close to finalizing the biggest merger in Southeast Asia. And of course, the final details were being worked out by the senior leaders of each company with the participation of none other than SoftBank's Masayoshi Son. And I would note that this isn't the only example involving SoftBank as a common owner. Earlier in this pandemic, SoftBank publicly voiced its preference for a merger between Uber Eats and DoorDash. Ultimately, that merger collapsed due to antitrust concern. I'll skip the next example in the interest of time. I'll just note that there are many other rather egregious cases featured in the paper, and I would encourage anyone who's interested to take a look at those. So to sum it up, people have called for evidence to determine the mechanisms through which common owners influence firm behavior. I offer concrete evidence for 30 cases found in the public domain. And I'll note that there are likely many, many more of these cases that go on behind closed doors. In terms of competitive considerations, I think it's easiest to group cases under 3 categories. The first are cases that are per se legal, such as a common owner of airline firms telling these airlines to raise prices and cut capacity. Others are not illegal, but may have anti-competitive consequences, such as performance-insensitive executive compensation. And then finally, there are others that may be efficiency increasing, such as common owners setting stricter emission targets for energy firms. So I'll end it at that and just note that writing this paper has helped me realize I think there should be significantly greater disclosure required from common owners so that regulators can fairly assess the consequences of a common owner's action. And thanks very much for listening.
Thank you very much, Nathan, for these. Well, we only had a glimpse at the paper, but hopefully many people feel encouraged to take a closer look. And it's also nice that you could actually find this evidence in publicly available documents. It would be, of course, also very interesting to know about others where these documents are not public. And this connects, I guess, rather well to the next presentation by Anna Zanaki, who also will speak about mechanisms of common ownership. Anna is a Marie Curie Fellow at Lund University at the Law Faculty. She is a Senior Research Fellow at the UCL Center of Law, Economics and Society, an Associate Editor of the JCLE, which is organizing this event, and also of Competition Policy International. She is working a lot on common ownership and cross-ownership. And perhaps as a free announcement, free advertising, she has written a forthcoming monograph on partial ownership of competitors in Europe, coming out with Cambridge University Press. Anna, the floor is yours.
Good afternoon, everyone. Thank you so much. Thank you to all the JCLE editors for inviting me to present my research and for organizing this event and the special issue. So I will try to share my screen. Let me see. Okay, so as Martin said, I will be speaking about my latest paper. So this is a fresh paper, and it's still a work in progress, so your comments are very welcome. And it's about the mechanisms, as Martin said, of common ownership and what I call varieties. I was trying to classify different varieties. As Martin said, I've been working on this book on partial ownership, so I'm trying to make some links to that and connect it to partial ownership, where the theory is a little bit more established. Today, so the JCLE issue is about common ownership and competition. And this is a recent phenomenon. A lot has been written in US literature. What is common ownership? It is when we have overlapping shareholders in competing companies. However, I mean, the easy case is when you have a complete overlap of all the shareholders are common across those competing firms. But what happens, the theory is more contested when those shareholders, the overlap of those shareholders is partial. So as the first speaker on this panel, Joe, said, you know, in Europe, for example, we have many non-common shareholders as well in many European companies. So this is a critical factor as well in this common ownership story. And the question is, if there are companies who share the same shareholders, and even though those shareholders may be small, minority shareholders, could or should we assume that firms and market operate the same as usual? So there are two lines of criticism in the recent debate on common ownership, especially with regards to empirical research in this field. And the first line of criticism, especially from people in corporate governance and finance, is, but look, these are really small shareholdings. They have minority positions and they're mostly passive. Is this true? So they argue that, you know, they get these positions as investments, so they do share in the profits of these rival firms, but they do not act to influence those companies, and importantly, they don't act to influence them with regard to their competitive strategy. So I was intrigued by this question, and the second question that intrigued me is about the mechanism, as we said. So what are the transmission mechanisms? This is the second big question in this literature. So the question is, as I said before, where we have a partial shareholder overlap, that means we have partial ownership from the perspective of the common shareholders in competing firms. How does that partial ownership actually translate into corporate or strategic control? And in the empirical studies that have been done by Azar, Smaltz, and others, the main assumption that has been used in terms of economic theory is that the control that the common shareholders have is proportional to their ownership stake. And there is some debate as to how we can actually justify this assumption. And the second part of this proportional control assumption is, oh, wait, do managers have perhaps a role in this framework when we think about corporate control? And should we also account about managerial agency costs, especially considering that, you know, the U.S. Corporate governance structure, very oftenly when we talk about public corporations, they have diffused ownership, and so managers are traditionally thought to be in control. So this is a motivation for the paper, actually what my paper is about. So I was trying to think through the concept of control in different contexts. First, starting from merger control regimes and thinking what is the role, why do we use merger control, and what is the role of control in terms of theories of harm. And second, and I found there are some discrepancies that I will talk next, but then I was trying to compare the legal regimes that we have in different jurisdictions to economic theories, both on competition and corporate governance, and think of control both in terms of market context, but also in terms of governance context. Next, I classify common ownership types into two varieties, as I said before. I call them concentrated and diffused common ownership. And the kind of common ownership that we talk about today that relates to minority positions by institutional investors is what I call diffused common ownership. And I will discuss about it more later. So about mechanisms, Nathan already gave some examples, so I will not dig too deep into this. But the main mechanisms are either shareholding voting, so shareholders have rights since they provide capital to the corporation, and the voting determines what actions the corporation will take. So one of the mechanisms is voting. Another mechanism, recent research by Smalt, Ederer, Anton, and Genet, they have a nice paper on compensation of executives and how that could affect the incentives of executives to pay more attention to the interests of common owners. And then I discuss the market for corporate control, basically mergers and acquisitions. As I said, Nathan gave some nice examples of that and how common owners can be pivotal in this field. And then I also briefly discuss the role of the law. It is sometimes said that fiduciary duties can excuse me, I think I got a message, can act as a constraint to the incentives that common shareholders can have. And I show when that could be the case. And maybe in this field, the answer differs from jurisdiction to jurisdiction. As Ioannis said in the introduction, maybe it's not only varieties of common ownership, but the context, both the legal context and the economic context matters in this field. And lastly, I conclude the paper with policy implications, and specifically I focus on merger control and I give some recommendations. So let me go a little bit into more detail of what I'm trying to do in this paper. So as I said, I was trying to see how different merger control regimes are structured. And I found some clear patterns and some less clear patterns. So when it comes to majority acquisitions, so when you acquire more than 50% of a company, you have clear control. So that in case you acquire full ownership, you have a full merger, or if you acquire more than 50% in any event, I mean, depending also on the governance structure, but most often you also acquire sole control. So those cases are treated uniformly in most legal systems. But cases of minority shareholding are a little bit more idiosyncratic. So there are different legal tests that we apply to cases of minority shareholding. And I mean, maybe you cannot read everything on this table, but the bottom line is if you look at minority shareholding, the column that says minority shareholding, you will see that for transactions below 50%, they're very diverse. Legal thresholds, legal tests, and different ownership thresholds that we apply. And so the natural question that sprang to my mind was, why? Why do we have such different tests? And interestingly, the European Union has a much more conservative test. So they only capture transactions that give rise to decisive influence. And as Florence said in the first panel, we are looking for lasting change in control. So it is a very high standard to catch. On the other hand, on the other extreme, Germany and the UK lie somewhere in between. But the US, as you can see in the bottom of this table, all partial acquisitions in theory can raise problems under Section 7 of the Clayton Act. And interestingly, there is a recent reform. Professor Valletti spoke about the reforms in Europe in terms of merger rules. But recently also the US authorities proposed some changes to the reporting rules. So, and interestingly, they suggest that institutional holdings are reported on an aggregated basis. So,
Anna, it would be great if you could wrap up in one or two sentences. Thank you.
Okay, so next, I said there is some interplay between competition or corporate governance and the extent to which shareholders or managers have control of the corporation, and that perhaps affects whether we have a merger or not in the competitive analysis. And then I talked about the new taxonomy. I link both cases of common ownership into the framework that O'Brien and Salop has developed for partial ownership. And in the first, when at least one company, we have more firms that have a common owner, and at least the common owner has full ownership and total control over one firm, this case is well accepted, but we can deal with under merger control. However, the second case, where the Azar and all literature is about, that we have minority common shareholders, it's much more debated, because then we have too many moving pieces, meaning both partial ownership and partial control, that we need somehow to specify. And to conclude very quickly, so I suggest merger control as a solution for this problem, and this could be like a tailor-made regime for common ownership in general, or in the more short-term future, we could scrutinize merger between portfolio firms of institutional investors, as it has been already done in Europe. And yes, we have the analytical tools. So I talked about the partial ownership framework. We need to refine the quantitative tools, like the MHHI, to account for the corporate control dynamics between shareholders, but also between shareholders and managers. And lastly, it is a good idea, I think, that we expand our reporting rules, as the US authorities have thought about, and that we use this also as a solution in combination with competition enforcement. So it will help us understand better what is actually the real landscape on this topic. Thank you so much.
Thank you, Anna, and I think you provided a great connection to our last speaker today, who will provide us with some policy insights. Mike Walker, Chief Economic Advisor at the CMA in the UK. Since 2013, member of the Senior Executive Team, Central Advisor to the Board, also an academic at King's College London, the College of Europe in Bruges, and co-author of the Economics of EU Competition Law. So it's great to have you with us, and thanks that you're willing to share your thoughts on this issue with us.
Great. Okay, so I'm going to make some policy comments, some based on the papers we've just heard, some more general policy comments. Dan O'Brien and Keith Wearer wrote a paper about 3 years ago in the Antitrust Law Journal, in which they said about common ownership that, quote, we know less than we think. And look, it remains the case that there's a lot we don't know about common ownership, but I think it's pretty clear that there's also actually a lot that we do know. And I think one of the things we do know is that we cannot be sure that there isn't a competition policy concern here. We know that common ownership has been increasing. Joe's paper that he talked about at the beginning of this session showed that in banking. We know that the Bacchus et al. Paper from the A&E P&P shows that common ownership has been increasing. So I think we certainly know that there's potential grounds for concern. I think we also know that the basic economic theory is very clear, and it's not new theory. Ioannis mentioned it at the beginning. You can go back to 84 to the Rothenberg paper, where it's mentioned in passing that ultimate owners have a reduced incentive to compete with horizontal competitors as they own a share of the profits of those competitors. So, of course, the horizontal theory of harm is pretty clear. Okay, maybe there's some vertical issues. Anthony presented some analysis on that. I mean, I have to say I'd like to see a lot more on that, because whilst I'm convinced that there may well be sort of these measures of influence, I'm less convinced that influence in a vertical relationship is going to be anti-competitive, because, of course, we're talking about vertical relationship, we're talking about complementary products, not substitute products, and so I'm less convinced that there are going to be vertical theories of harm. But look, Anthony, come back and tell me why I'm wrong. So, having said that, why, from a policy perspective, might we continue to be a little bit careful in this area in terms of not intervening immediately? I mean, I think there's a couple of concerns here. One is, of course, that the empirical analysis is still very controversial. I mean, we know there's evidence of harm from these various papers. So we know Joe, paper of Alba in the pharma industry, shows that common ownership between brand owners and generic manufacturers significantly reduces the likelihood of generic entry, harmful to competition. We know from the original Azar et al. Paper that a suggestion that common ownership has increased prices in the US airline industry significantly, sort of 3 to 7%. As the paper Anna just mentioned, the Anton et al. Paper on compensation schemes, suggesting that common ownership leads to compensation schemes that are more skewed towards industry performance rather than firm-specific performance. And, of course, that's likely to lead to anti-competitive outcomes. So we know there's a bunch of evidence out there. We also know that there are very considerable concerns empirically over the use of the modified HHI as an explanatory variable here. So whilst there is all that empirical analysis out there, that empirical evidence, I don't think as yet we can be sure that empirical analysis is robust. That said, I think the recent paper by Boller and Scott Morton, where they look at the effect of firms entering the S&P 500 and how that seems to give firms a share price bump, and the argument there is firms come into the S&P 500, they become part of the index, therefore this increases common ownership within their sector, and then the share price bump seems to suggest investors expect more profits. That is consistent with an adverse effect from common ownership, and which wouldn't be subject to endogeneity concerns around the MHHI. So, I mean, I think the empirical evidence is reasonably strong, but I don't think as yet it's quite strong enough for us to be sure. And the other big issue empirically is around what is the mechanism. Now here I am much more relaxed that the story is good. I mean, a number of reasons. One, it is just the standard principal agent problem, and markets are really good at solving principal agent problems. That would be my starting point. So I would expect the market to be able to solve this mechanism problem. Now, secondly, I mean, Nathan, in his very nice paper, highlighted a number of ways in which the mechanism might work. Anna also mentioned some. I note with some amusement that asset managers and fund managers, up until a few years ago, were very keen to tell us how much influence they had on management of the firms, and now suddenly they've said, no, we have no influence at all. I don't believe them. So, I'm not that concerned about the mechanism. So if the empirical analysis and the issues around modified HHI are solved, then I think we've got a pretty good body of evidence there's a problem here. So where does that leave me as a policymaker? Well, a couple of things. Well, first of all, why might you not intervene? You might not intervene because empirical analysis is not yet robust. I think that's fine. So we want more work done there. We might not intervene because actually the benefits of diversification are so great that they outweigh any harm from common ownership. I'm not really convinced by that. I mean, the Scott Morton Posner Glenoir paper from 2 or 3 years ago, highlights the fact that actually most of the benefits in diversification are from diversification across industries, not within industries. So, the loss from only being able to invest significantly in one firm in each product market isn't actually that great in terms of diversification benefits. I also am struck by it's another Scott Morton point actually that if there is harm around here, then all consumers are harmed by common ownership. Shareholders may benefit from it. You would expect the first effect to be a first order concern that affects all the deciles, including the bottom deciles of the income distribution, was a second effect, well, arguably a second order effect, and also won't be benefiting the bottom deciles, so maybe a distributional concern. So, I'm inclined to think that I certainly think that we should continue as competition authorities, as policymakers, to be very concerned in this area. But as yet, we haven't quite got enough empirical evidence to intervene. The final comment I would make is I'm not sure. Well, no, I don't really agree with Anna on this, although I may be misunderstanding her point, which is I'm pretty wary at the moment of bringing common ownership concerns into merger control, because it seems to me that the implication is that we should be relaxing merger control. So if we're in a world in which we think common ownership is a problem and that firms are already taking into account the profitability of their rivals as a result of common ownership, then that is going to reduce the effective delta from any merger, and therefore is going to reduce the harm from any merger. So if we're taking this seriously, that suggests that we are going to be relaxing merger control. And it seems to me you're a pretty brave person at the moment to say that merger control has generally been too fierce. So I would not at the moment be in favour of taking common ownership into account in merger control, because I think it moves us in the wrong direction. And with that, I will stop. Thank you very much.
Thank you, Mike. We have a few minutes left for some discussion among the panelists, and perhaps as an input, I would like. So first of all, I would like to give the floor to Albert and Alina in case they want to add something in light of what has been said. I would like to also add. I think the argument or the point made by Mike, which has been made, I think, by a number of people in the among practitioners, that bringing in common ownership into merger control may lead to relaxation. I do see that point, but I guess it depends very much on the specific market whether it's indeed leads to a relaxing position, because if we account for common ownership prior to a merger, it means that the initial market is already more concentrated. Then it depends very much on who are those parties who are proposing to merge. And therefore I would not see the view confirmed that it's necessarily leading to a relaxation, but there is, of course, the risk. And what I would like to ask Joe and Alina, in light of what they have been working on, what are the kind of evidence we really have to go for in order to move towards some antitrust case? Perhaps I give the floor first to Joe.
Hello. So just to repeat a bit the takeaways that Joe was mentioning from our paper. No, so the first is that most of the evidence we have essentially in common ownership is based on America, no, on the U.S. data and the U.S. setup. But I think this study that we have shows that the patterns in Europe are very different. There are governments and also individuals and corporations that are very important in Europe, and more so, in fact, after the financial crisis. So I think here one of the things that clearly this calls for is, of course, more research. And I'm not just going to leave it there. So I'm going to say that we're actually, and I'm also going to be using a bit as advertising if you want. So we're doing such research, right? We're looking in a separate project also with Johan and Nuria on the effects that common ownership and non-common ownership prevalent in Europe might have on firm markups and productivity. So we use European data across many different sectors, and we look at the effect that this might have on markups and productivity. So just to say that we're also trying to advance in that respect. So we should be hopefully publishing the results very, very soon. Thank you.
Thank you very much. Perhaps Alina, you want to step in and also tell us why we should be perhaps more concerned about the vertically related market issue?
Thank you, Martin. Can you hear me okay?
Perfect.
Fantastic. First of all, I completely agree with the point that you raised earlier, and I believe Mike reiterated that it's very important to, before we start being concerned about the vertical aspect, to identify, first of all, what are the mechanisms, and second, what are the welfare implications of the potential outcomes of the mechanisms within the vertical aspect that may lead to changes in the market. And this is specifically why, instead of starting with the measure and then trying to link it to the prices, perhaps it's important to highlight we're working in two directions in our paper. So what Anthony explained before, we are exploring a more nuanced way to measure the links between the companies in the market, but we're also using this nicely self-contained data set from the Greek supermarkets, which allows us to, before we start making any conclusions about the vertical links, we can see the dynamics of the change in the prices, of the change in the goods composition, for example, the supermarket's own label versus the competitors' labels being present in the stock. And so this way we can primarily identify whether there are substantial changes in either the prices or substantial changes in the representation of the competitors, which would then, for example, indicate potential foreclosure between the firms, and then we would link it back and try to see if that in any informative way links back to the network-based measure. I think from this perspective, we really agree with Albert's point that European market and the US market might be quite different, and even between the countries, the composition of the ownership and the welfare impact, especially on the consumer side, may vary.
Thank you very much. I think these were also perfect concluding words, which in a way allow me to be very short on this. Our time is up. It would have been very nice to continue discussing. I'm sure that this topic will keep us active for quite a while, so there hopefully will be other opportunities to continue to talk about this. This is all I want to say for now. Thanks a lot for being with us, and bye-bye.
Thank you, Dr. Peitz, for guiding the discussion. Thank you to all speakers for your invaluable contributions to the topic of common ownership. I imagine that a break now is more than welcome. So let's take a short break and resume our work at 4:45 p.m. GMT. We look forward to you joining us after the break. Welcome to the third and final segment of the JCLE Conference on Common Ownership, Interlocking Directorates, and Competition after this short break. The last panel will focus on examining the policy perspective on common ownership and interlocking directorates. To guide us through the discussion, it is an honor to welcome, as a moderator of this panel, the chairman of the OECD Competition Committee, Dr. Frédéric Geny. Mr. President, thank you for your participation. Monsieur le Président, on vous remercie pour votre participation. La parole est à vous.
Well, thank you very much. Ladies and gentlemen, welcome, therefore, to the last panel of the conference, which is devoted to the question of investigating the policy proposals which have been made to try to remedy the common ownership problem. Now, we are going also, if there is enough time, to look at the related issue of policy proposal with respect to interlocking directorates. On the first issue, that is on the issue of common ownership, as you will see, there are differences of appreciation between economists in the US and in the EU on whether the use of regulatory solution is warranted. On the second issue, which is the issue of interlocking directorates, there are different solutions to deal with the problem in the US and in the EU. So this issue, or those issues, are not at this point a clear area of transatlantic convergence. The differences may be due to differences in the significance or the effects of the phenomenon, concentration, the common ownership on one side, and interlocking directorate on the other, on both sides of the Atlantic, or to substantial differences in the approach to regulatory oversight. And this is what we are going to explore today. To discuss those issues, we have a great panel with Fiona Scott-Morton, who is Theodore Nierenberg Professor of Economics at Yale University School of Management, Ioannis Lianos, who is the President of the Hellenic Competition Commission and Professor at UCL, Jean Bergevin, Head of Unit Antitrust and Financial Services at the Directorate General for Competition of the European Commission, Pierre Régibaud, who is the Chief Economist of DG Comp, and Scott Hemphill, Professor of Law at the NYU Law School. So I think we should start. I'm going to ask Mr. Régibaud and Ioannis Lianos to talk first about respectively horizontal versus vertical common ownership and whether common ownership should be extended. And then we will go on the regulatory proposals in the US and in the EU. So Pierre, you have 4 minutes on horizontal versus vertical common ownership.
So here is the truth in 4 minutes. We all used to think of common ownership in horizontal terms. And we know that the answers to the effect of common ownership and also the interaction between common ownership and things like merger policies depend essentially on two sets of factors. The mechanisms involved and the kind of pattern of common ownership that we have. In terms of the mechanisms, there are essentially three effects, right? There's a usual incentive effect. If I own part of you, I'm not going to compete with you as much as I otherwise would have. To be translated into action, this indeed requires that I have some control, some influence on my own firm. Control on top of this, then intervene if I also have some control on the other firm. That's kind of an additional layer. And then there's a dimension of exchange of information, right? On this layer of complexity, then you have to lay a layer of complexity on the pattern. Do we have from A and B having common ownership? Is this reciprocal? Or is this A owning in B owning in C? Or is A and B owning in C? Or A and B owning in C and D in the same market? And all of those things require different analysis. So I want to emphasize that even in the realm of what you think we know, the horizontal dimension of the beast, there are subtleties that one usually doesn't take into account. But there are also, of course, common ownership in vertical chains. And there too you can think of layers of complexity. But what I want to point out here is that actually the kind of things that we worry about here will be very different. Except if you have very long chains of common ownership, we probably do not worry too much about transmission of information, because it would only hurt if you ended up transmitting information between two horizontal parties through indirect chain. It certainly doesn't hurt in the vertical chain itself. So what we worry about is, of course, as usual, the effect of joint ownership on the possibility of foreclosure. So in a sense, it's a little bit like a mini merger. But we also worry about somewhat different things that one doesn't always think about, is that partial ownership in a vertical chain can also give rise to the kind of common agency issues that we sometimes struggle with in the scope, in the context of vertical merger. And so having pointed out the significant difference of those two and the degree of complexity that they involve, I will stop.
Okay, thank you very much. That was very clear. So we don't have a problem, we have a set of problems. And what we want to focus on depends very much on the type of and the particular organization of the common ownership. So I'm sure we'll come back to this. Now, let me turn now to Ioannis. Ioannis, I think that you want to ask whether the common ownership literature could be extended to different circumstances. So why don't you come and tell us what your ideas are on this?
Thank you very much, Frederick. So obviously, what I would like to take from this debate is how we can implement some of the insights of the common ownership literature in other situations of common ownership, not necessarily by institutional investors, as usually the literature has been framed, but in more traditional, to a certain extent, economies with less financialization, the possibility to implement some of the insights of this literature for other types of common ownership, for instance, common ownership through family ties, in particular when we see in some more traditional economies the importance of family groups and funds and their involvement in various areas of the economy and different markets. Sometimes even for companies that are in competition with each other. And to a certain extent, if we look to this issue, the concept of family links is not absent from the European merger control regulation. Actually, it's mentioned as a factor that could be taken into account in the context of Article 3, Paragraph 2 of the EUMR concerning the concept of control, in particular to determine on a case-by-case basis the existence of indirect control and possibly also with regards to de facto control, the idea that there might be some links between family links between important shareholders with the large minority shareholder. But also they are taken into account in the context of Article 5 of the EUMR regarding the definition of turnover. And indeed, for the purposes of calculating the turnover undertaking, acquiring control, the turnover relating to all entities belonging to the group must be considered. And Article 5, Paragraph 4 sets out specific criteria for identifying undertakings whose turnover can be attributed to the undertaking concern. And here, of course, we have a different kind of approach than Article 3.2. I mean, it's not really, this criteria of Article 5, in particular the right to manage the undertaking's affairs, is not coextensive with the notion of control under Article 3.2, because basically these two provisions fulfill different roles, while, Article 3, Paragraph 2 covers situations of economic dependence that may lead to control on a de facto basis. The aim of Article 5.4 is to capture the total volume of the economic resources that have been combined through the operation, irrespective of whether the economic activities are carried out directly by the undertaking concern or whether they are undertaken indirectly, the undertakings with which the undertaking concern possesses the links described in this provision. So in this context, the competition authority might pierce the corporate veil and address the real competition situation. For instance, where Mr. Y may own a wide range of companies, but a major acquisition is made by his wife. If the acquisition is made at Mr. Y's request and out of his funds, it seems right to pierce the veil and consider Mr. Y to be the undertaking concerned, since the accusation is in reality made on his behalf. In contrast, if Mr. Y and his wife each makes acquisition out of their own respective funds, and if they do not run their respective companies together, but as a separate group, they must be treated individually when calculating turnover. So the dividing line so far is drawn between those situations where the individuals act independently and those where they act either on behalf of someone else or jointly. However, this doesn't really take duly the possibilities of control and coordination between family members, for instance, Mr. Y and his wife, into account. So the question is, therefore, and this is basically so far what the main focus has been in the EU merger concerning family ties. There's very little EU case law generally on what exactly is meant by family ties, and this is not a problem only in the context of EU merger control, but more generally in the way we define the concept of undertaking under Article 101. And in particular, in Siderurgica, Irish train Madrid, the court held that the simple fact that the share capital of two separate commercial companies is held by the same person, the same family, is insufficient in itself to establish that those two companies are an economic unit, with the result that under European competition law, the actions of one company can be attributed to the other, and that one can be held liable to pay a fine for the other. So basically the fact that you're just a family is not sufficient to consider, to basically constitute evidence of economic unit. But again, I think it's quite interesting to look to basically, assuming that being part of the family or having family links might somehow serve the role of a transmission mechanism that we have been discussing quite a lot in the context of the institutional investors, and we, and to a certain extent, we need to build up a little bit this area. I think it's quite interesting to assess how, not from the perspective of a substantial lessening of competition or a significant impediment of effective competition, these family links may play over. There is so far, the case law has been merely about the concept of de facto control, or what should be taken into account, the turnover of the family linked company, but there hasn't been so far an analysis of the implications that what might have on the fact that some companies might be influenced through various shareholdings by the members of the same family. And I think it's quite interesting to look to the case law about family ties. There is also even case law in the US. I found actually quite interesting case of 1995, Community Publishers versus Donnery Corp, concerning the application and enforcement of Section 7 of the Clayton Act, concerning substantial lessening of competition. But again, the topic wasn't really about should we take into account this for the purposes, and I'm ending here, for the purposes. Yes, hello?
We lost you for about 2 or 3 minutes?
Yeah, no, that's fine, because I was continuing talking and this was recorded, so there's no problem. Actually, we had to do that, don't worry. But again, the idea is... Yes, so the idea is what I'm basically saying is that the family ties could be extremely important area to do some additional research with regards to how this could affect the possibilities of unilateral effects taking place in this context. In particular in this U.S. case that I was mentioning before, Community Publishers versus Donnery Corp, the fact of the matter was that because of the family ties, the court found that there was no incentive, basically, for the two parties, two journals, two newspapers, to compete at the marketplace, because basically they were both newspapers that were merging, part of the family's investment body, and to a certain extent, if competition was to prevail, this family will not bear only the cost of improving the newspaper that they own, but also the decrease in the value of the other newspaper that was owned by a different part of the family. And it's quite interesting to see, and also quite funny to see a little bit the type of evidence that the court relies upon in order to establish the family links. For instance, I mean, they refer to the strong personality of the paterfamilias of that family, and I quote everyone suspects that Mr. Jack Stevens, that was a paterfamilias, such a strong personality that his wishes are usually carried out without the necessity of direct orders from him. They just intuitively know what he wants and they do it. It's really interesting as evidence of transmission mechanism in that context. So what is really missing from this literature, and there's actually quite a few cases also about family ties in Turkish competition law. Actually, I found 5 cases where the topic comes in, and actually quite interesting that it comes in Turkey, because also the structure of the economy is very much based on actually quite important families controlling parts of the economy. It's quite interesting because basically the court there assesses the economic and familial relations. It tries to determine the roots, characteristics, and scope of economic relations and compare them with independent entities, and tries to determine the unity of interest by looking to really a wide number of factors, including links in terms of weddings, etc., or participation in as shareholders in the same companies, or even presence in the same relevant product market. But what is interesting that this case law exists, but not really in order to assess the existence of a significant impediment of effective competition, but merely in order to answer the question: is there control, de facto control, and should we take into account the other undertakings in that are controlled by the family or influenced by the family when in the context of the equivalent in Turkey of Article 5.4 of the EUMR. So what is really missing here now is probably looking to the evidence coming out of empirical analysis that family ties might possibly lead to the similar type of problems that we have in the context of common ownership and minority shareholdings. Quite interestingly, the US case on community publishers versus Donnery Corp refers to minority shareholding as an inspiration for what they are actually doing in the context of family ties in this case. And in order to do that, I think competition authorities, in particular in more traditional economies, should probably do a more extensive mapping of the market, including finding out structure of ownership of the various important sectors of the economy and companies that are present in it. And to a certain extent, this is probably an interesting area for future research that could be of interest for competition authorities in Southern Europe in particular, and I guess also in the rest of the developing world more generally. Thank you.
Okay, thank you very much, Ioannis, for this attempt to extend the concept of common ownership to family ties. First of all, I think that the problem that you raised is a problem in many small island economies as well as in small countries. Second, I wonder whether a regulatory solution would be a good one rather than a case-by-case examination of what could be the ties. And one of the weaknesses of your proposal, of course, is that there's a definition of how far you go in defining family ties, because you can also have groups of people who are not in the family but tend to have close relationship. Just a small memory, when I was on the court, we were faced with that issue at some point in banking law. We had a case where a woman had been the guarantor for a loan, and then the person who had taken the loan couldn't repay, and the question was, and the bank was going after the guarantor. We have a law in France that says that if you're a guarantor who is averti, knowledgeable, then you have to pay if the loan hasn't been paid back. But if you were uninformed when you became the guarantor, then maybe you don't have to repay the loan. the question was that this woman was the wife of a banker. And the question that we had to decide that, was it likely that the wife of a banker would not be knowledgeable about the guarantor, about being the guarantor of a loan? And of course, there is no good answer to that. I mean, she may have shared the life of a banker without having any particular interest in banking activities. So I think it's an interesting area for research, but I wonder whether there are regularities that could lead themselves to some kind of regulation. So talking about this, I would like to go now to Fiona. You have made proposals of a regulatory nature to try to deal with the issue of common ownership. So would you tell us what are those proposals, where the issue is in the US, and then we'll go to the EU to see whether there is similar feelings.
Sure. Many thanks for the invitation to speak today. I think Pierre really laid out the issues, but to recap, when the same party owns all or part of competing companies, and that ownership generates some form of influence or control over those strategic choices of those firms, then there's both the incentive and the ability to lessen competition. And we know this very well in mergers. We have merger control. We know this very well for minority stakes. We have a review of those also. We have the history in the United States of trusts like American Tobacco and Standard Oil and railroads, where independent companies were placed into effectively a holding company and stopped competing. And today we have the new problem of the modern mutual fund, where perhaps a mutual fund might own 5% of a publicly traded company. But there might be several mutual funds that own 5% of the competitors in the marketplace. 5% might be about the largest shareholder of that company. And the mutual fund might have a corporate governance function. That is to say, there might be some people there who think their job is to pay attention to what the company's doing and monitor management and so forth. Okay, so what do we want to do in this situation? There's two goals that our proposal takes on. So one, of course, is, well, the overarching goal is, can we get competition back? But the constraints are, we want to keep a robust mutual fund industry because this is an efficient way to save. It's diversification available very cheaply to savers, so that's good. We also want a policy that is agnostic to the mechanism because right now we don't know what the mechanism is, and there may be multiple mechanisms and they may differ across companies. So, for example, are shareholders, are common owners meeting with management? Are they voting a certain way? Do they have board seats? Do they design compensation packages? There's a variety of different mechanisms that could be at work. And given that we don't know what the most common one is or any particular industry's mechanism, we want a policy that's robust to that. So what we propose is a safe harbor. The regulator says, look, you might be sued for an antitrust violation because you are lessening competition. We'll make a safe harbor where a common owner can be if they only hold one company in an oligopoly, provided that they're above a certain size threshold, like 1% we pick in our paper, but that's not, doesn't matter. And we exempt in our proposal a very pure kind of index fund. So if you're an index fund that can't vote with your feet because you have to hold everything and can't vote in with shares and doesn't talk to management, and this requires some change in the law because you'd have to find a way for that index fund not to be voting with shares, then that would be exempt. But leave that to aside. In general, the mutual fund can only hold one company in an oligopoly, and if they're of any size, and what we would say is that the FTC or some government agency defines what an oligopoly is. And why would this help us? Because diversification, it turns out, comes from multiple industries in your mutual fund, not from multiple firms. The airlines move together, banks move together, those stock prices. So I've done work with a colleague in finance at the Yale School of Management, Will Getzman, where we show this. And so you can get pretty well all the diversification that there is from across industry diversification. So there's very little loss to the shareholders from this rule. And I'll say one more thing, which is while the FTC or a government agency could define oligopolies and who's in them, that would be necessarily imperfect. And the point of this policy is not that you could achieve perfection, because, of course, a corporation is not the same thing as an industry or a product market of the kind that we use in antitrust. But nonetheless, we think that you could make a good deal of progress. Boeing and Airbus, Coke and Pepsi, airlines, domestic airlines in the US. These are cases where the corporation does compete strongly with another publicly traded corporation. So this kind of safe harbor, I think, would do a lot. It's pretty well no cost, and it does not depend on any particular mechanism. These are the kinds of policies that I think should be put forward. I think it would be useful if there were more of them. More people proposed various things because this is a very widespread phenomenon. And if we have a problem, it's a big problem. We don't know for sure that we have a problem yet, but I am quite worried about it because of both the incentive and the ability for common owners to engage in this behavior. I'll stop there.
Thank you. Okay, well, before we discuss this, let me go to Europe and ask Mr. Bergevin, what is the situation in Europe and what are the proposals, if any, which are on the table?
Thank you, and I apologise for having to do it this way, but the internet is internet, and I don't know what's happened in my home working condition, but the internet's gone dead on me. So many thanks for being patient with me on this. I'll keep my presentation short. I apologise because I missed the beginning of this panel, but I have been listening to the other panel sessions. Just to explain, really, first of all, from our point of view regarding the whole issue of whether there should be some kind of regulatory initiative, and also to put in context the study that we commissioned from our colleagues in the JRC and that we published this September. Just on the history, because I heard Tommaso saying, well, yes, but then we threw it back to the academics saying we need more research. I think it wasn't quite as simple as that, if I can be quite honest. It was very much as the issue reignited, really, with the work of Azar and others and the debates in the US. Our intention with the JRC was to first get a better mapping of the situation, the phenomenon in Europe of common ownership. And that is effectively why we did that study. And I heard very much also what Joe has, what they did for the European Parliament on banking. Just quickly, because this is the policy debate, but 2 or 3 things that came from the study which I think are useful thinking in terms of the policy debate. First of all, the measurement point that Mike Walker made earlier as well. I think that the JRC has actually proposed a methodology based on density and network analysis, which seems reasonable and which seems to go in line with some of the other panel presentations from the previous panel. Secondly, the big issue which came from also the first panel, I think, is the measurement of the markets. I mean, it took our colleagues in JRC using Orbis a good year and a half in terms of data mining to be able to do a mapping for the all listed companies in Europe. And then we did it for 5 particular sectors, which was oil and gas, electricity, telcos, trading venues and beverages. And you may ask, why did we do it for those 5? Largely because we had the market intelligence both within the JRC and DG Comp to effectively define those markets from a perspective, if you like, of competition, which is different from the standard NACE classifications that we found in Orbis. So that took a lot of work, quite a lot of mining. The results go in line with everything we've heard today, in the sense that the phenomenon is widespread and increasing in Europe, But where I would also agree with, I think it was Yaron beforehand, is that it is not only an issue of the passive asset managers, which everybody talks about, but also banks. And that's not just banks in their own sector. I mean, that is banks generally in different sectors, and of course states, sovereign wealth funds, etc. So something that needs to be taken into account is that it's not solely, although our analysis started off because of questions regarding the size of passive asset management, it is not solely those who are, the common shareholders, let's put it that way. The other findings we had was that it was particularly pronounced in the largest firms, so which again I think is recognised across the literature now. And what the second part of the study was actually to try and assess, at least for correlation. Again, we were very dependent on data availability, which is a major issue here, of course. And we did it for, or rather the JLC did it for the beverages, the soft drink sector. And basically the econometric analysis was based around the structural event, if you like, of the BlackRock BGI Barclays merger back in 2009. Now, I'm going very quickly because I want to get to the policy points. What came out from that was clearly, first, there was a correlation looking in terms of the increase of common ownership for those firms that increased, if you like, in terms of common ownership because of the merger. Interestingly, the strongest effect was for those firms, the smaller firms, being impacted by it. And the other thing is, again, is that that correlation certainly was statistically significant. However, as you know, that can be explained by many factors. We were looking at the effect on profitability in terms of the land index, but it could be explained by many factors. So we say clearly, I think the study rather says clearly, that with all those caveats, there is certainly a positive correlation. And the outcome of that is not to say, right, please go away and do more research and we'll cut back. It's more to say, I think the policy implication we've taken is that the phenomenon is certainly growing. For all the reasons we've heard today, it is something that we should monitor, but we do not have sufficient empirical evidence, in a sense, to take a strategic move of saying that we should act with a specific measure or in a certain way. Now, what I draw from this also, and this is more from a personal point of view. So from a policy point of view, we are continuing to monitor this, as are our national authorities. And of course, many markets are national. I think when Joe's talking about banking, even banking, as you saw with the Italian example for cross-directorships, we have still quite oddly, but it's true, we still have a fragmented market in banking, etc. So the national implication of this is just as important as the European one. So I wanted to make that point as well. What I would say is that one of the things, and I'm really sorry that I didn't hear the paper, the discussion beforehand, but one of the things which is important is I think one needs to look also at the incentives. There will be different incentives depending, I think, on the type of common shareholder. So whether it's a state, which by the way in banking would have intervened certainly after the crisis, it had to, in a way, or an institutional investor or a fund vis-a-vis a bank. That's the first thing. In terms, I don't think we can treat them all in the same way. Secondly, I think in terms of the transmission mechanisms, yes, there are, certainly, and I heard the paper earlier where one can take examples of what we hear. But I think that there's a tendency to think there's a one-to-one between the common shareholder and the portfolio company. And if I may say, that's rather simplistic. I think you have to look at also the different intermediaries in this chain, and in particular, as an example, on voting, how it works with proxy advisors in terms with the common shareholders. Is that an influence channel? I'm not saying it is or not, but that's certainly something that should be taken into account. And maybe even more significantly, with the index industry. Why do I say that? Because I was, again, listening to Mike Walker's comments at the end, where he was saying the whole move to, certainly with passive asset management, came from the move to index tracking investment, came from the issue of portfolio diversification. And he, as you rightly said, that shouldn't be an issue if you're investing across different firms. When you look at the major indices, if you're talking about the S&P 500 or the FTSE 250, that is cross-sectoral. But what one certainly is aware of is a massive increase in indices. There are far more indices these days than there are securities. And some of those are actually sectoral indices. So, you know, that is something that needs to be, I think, looked at, because certainly from the point of a company, a portfolio company I'm talking now, that it wishes to get into index, and many of them do, particularly new companies who wish to go for listing. They want to get in index because of the effect it has on their capitalization, and a very strong positive effect. I think the issue about the index industry and how that works with institutional investors is something that shouldn't be, you know, put to one side. But that's very much a personal view. I fear that this presentation is completely disjointed from what my peers have been saying on this panel, but I hope nevertheless that it will contribute to the thinking. And thank you very much, and apologies for my lack of connection to that. I do apologize.
So let me turn to, and this sets you quite differently, much more cautiously, I would say, than the proposal which has been made by Fiona. Okay, so let me turn to Frank Regibaud to add to what you just said, and maybe to outline some methodological issues which justify the European reservation towards the regulatory proposal.
Okay, so let me start directly, essentially, with Fiona's proposal. We all agree that you need a step to go from incentive to the ability to act on those incentives, right? And we all agree that what this mechanism is can be very different in different situations, in different industry, in different companies. Therefore, I completely agree with Fiona that if you're going to go for something like a safe harbor, you cannot possibly have a safe harbor that would be dependent on the mechanism, because, you know, one can already question the overall empirical evidence that we have overall, but we certainly don't have empirical evidence of the mechanism. So clearly, if that's the kind of policy you want, you have to make it independent from the mechanism. But if it's just a safe harbor, we just says if you below that is safe, after that we might bother you. Let's not forget that then in order to really get enforcement, you're still going to have to make a case, and in Europe that's eventually going to have to convince a judge. And that's where I would argue it's very, very necessary to go back to the mechanism. Let me give you two reasons for that. Suppose that there is a case in the car industry, and the appeal, and I find myself in Luxembourg, and the judge says, so why do you think, so just each had 3 or 4%, that doesn't seem much. Usually, I go back to cases like Ryanair and so on, we're talking about much bigger percentages. This is what should I believe is the problem? And I say, but there are some excellent papers, statistically well done, that actually might even show causation, that says it's a problem, for example, with the airline industry, And in the pharma industry, and the judges say, yes, but we're not in the pharma industry, and we're not in the airline industry. Well, in other contexts, I might not be good off. I may say, yes, but all these industries share common characteristics that explain why we have this relationship. Therefore, I can learn from other industry and apply it there. That's where I don't see myself saying this for common ownership. Why? Take, for example, one of the industries where I really believe in the effect much more than in many others, which is the airline industry. Believe in it not only because it's very concentrated, but because one of the essential dimensions of competition in airline is not just the daily pricing, is which rule you make, which have big decisions. And we know from corporate finance that first there are different voting rules and so on, but it's easier with a smaller ownership to block big decisions than small ones in terms of transaction costs and monitoring as well. Now, therefore, if I have strong evidence for this airline industry, I cannot transplant it to another industry with a crucial dimension of competition and much more day-to-day kind of decisions that are much less amenable to influence by shareholders. So that's my first point. The second is that if I go to the judge, they don't like correlation. They don't always understand causation. And even if the judge was sympathetic, remember that what we're going to be discussing legally is behavior, is conduct. So the judge asked me, yes, maybe, but what did they do wrong? How did they influence the decision? And if I don't have a story to tell that, my really conviction is that I'm going to be out of luck. So from that point of view, on this concrete end of enforcement, not just the safe harbor, I think you need to talk and to document, to talk about mechanisms, document them, as we've been doing, both in merger and in other cases we've been doing with minority share ownership and cross-ownership for a long time. And for example, in Ryanair, actually I worked for Aer Lingus in the Ryanair case, and we spent a lot of time looking at the different rules for different decisions, how many people usually vote. So really a lot of time on the transmission mechanism from the incentive to the action. And I think that in concrete decisions, this is needed. And I stop.
Very good. But I just want to make sure I understand what you said. You explained that if there is a proposal to have a safe harbor, after that there would be enforcement problems because you still have to find the mechanism. But what if you have a regulation that says you just cannot have more than X% of one firm in an oligopoly, and that's it? It's not a question of safe harbor in that case. It's just a question of regulation. Would you support that?
Well, if it doesn't go to ridiculous thresholds, yes, I'd be more comfortable with that. Although, frankly, I'm not totally convinced that the evidence we have so far, especially about how robust the results are across industry, is quite high enough that I would be quite ready to jump. But conceptually, that would be more attractive, yes.
So you say if we had the evidence that there was a problem in Europe, which we don't yet have, then I would rather have that type of regulation rather than something else, right?
Yes, I think it would be logically stronger.
So I would like to jump in just for a second. I agree with Pierre in the main, but I will say, Pierre, that if you were looking at this as a merger rather than as unilateral conduct, where we're constantly predicting the future, you have a little bit of an easier time saying, in these other industries, this kind of characteristic caused a problem and caused anti-competitive outcomes. Therefore, we are predicting it would do the same here. Yeah, and I think that's a normal way to reason in a merger context.
Yes, but in merger, all incentives, we assume all incentives are aligned. So it's really an extreme case where we don't have this step to take from the incentive to the action. So that's. So I think we agree.
If we're thinking about the common owner buying up an asset that's a competing asset, I have 10% of firm A, now I'm going to buy 10% of firm B, then it seems to me that we're in a pretty familiar territory, and we don't normally in a merger have to say this is exactly the way that competition will be lessened. This following product is going to raise its price by this amount plus exit over here.
Because in a merger, we know that all of the shareholders' incentive are aligned. So clearly, the presumption that on something where everybody's aligned with the company, management is going to be influenced is a good assumption. All I'm saying here is that if you have low enough participation, you cannot make this jump here.
Okay, so I think we're in different models, but I would still stick by my point. The second thing I just wanted to correct, Frederick, is you made it sound like the U.S. was moving forward with a regulatory proposal and Europe was objecting. Let me quickly say there is no appetite to fix this problem in America as far as I know. We are well in the mode of the government is quite keen to protect corporate profits and not competition. And though there have been people suggesting that this is a threat to competition for some time, I have seen no action whatsoever on the part of the government. And last, you also characterized Jean's remarks as being that there is no evidence of a problem in Europe. I actually heard it differently. I heard him say that there is a great deal of common ownership, but that there has not been a study about causality as to whether that has an impact on competition. And I would just remind the audience that an absence of evidence, because, for example, there's no data to measure it, does not mean there's no problem. It means that we don't know if there's a problem, even though we know there's a great deal of common ownership. So I think that's quite an important distinction to make if one is risk averse particularly.
Okay. Good points. I completely agree. So, but we still have so I'm going to rephrase what I misstated. It's not that there's appetite in the US for regulatory. There is support in the there's strong support in the academic community for regulation. There hasn't been the same support from the community of economists in Europe for pushing in that direction. Okay, so the intellectual debate, and I quite agree with you that we're not talking about institutional, but we're talking about ideas. So what we do have are two sets of economists who don't quite agree with each other, as we've just heard in your debate. So that is an interesting circumstance, and I would like to turn to our friend from Hemphill from NYU to say, from the point of view of the law, from the point of view of regulation, Scott, what would you advise when we have two sets of economists who don't quite agree with each other on the severity of a problem? So we've heard Fiona, who said, well, in that case, you want to be risk averse, and therefore you want to have regulation. What should one do from the point of view of antitrust enforcement in that case?
Yeah, sure. So, and in part of my remarks, I'll take a step back, I think, about how to characterize the evidence, about the evidence, I guess, and the consensus or lack thereof among economists. So first, I just want to thank the organizers for this really stimulating discussion today. I mean, common ownership is really fun to talk about. It hits all the sort of pleasure centers of an economist or lawyer's brain. It's really important. It's got that big if true flavor to it. If there are widespread anti-competitive effects, and the implications here are massive. And second, it's fun, right? I mean, a lot of these papers in this space are making a pretty simple theoretical move. Tweak the profit maximization of the firm to take account of a rival's profits, and then that internalization idea can be applied all over the place. Prices, contracting externalities, innovation spillovers. You can do horizontal versus vertical. You can go all over the place. To put my bottom line up front here, I think I want to strongly agree with others in the conference that based on our state of current knowledge, this topic clearly deserves all the resources in the world and attention from academics, from competition authorities. I'd agree, though, with I think what we heard from Jean and also Mike Walker, that we kind of don't have the goods here yet, right, from the standpoint of vigorous policy action. And I think the reasons here have to do with some of the complex interactions between competition and corporate governance that José raised in the first panel. I mean, this is partly a question of, as John noted, different incentives and obligations of investment advisors, which make this a very different story than if, say, Berkshire Hathaway was owning all the airlines, or a substantial piece of them. And second, some complex interactions, some upside from institutional investors that we have to take into account in thinking about policy. And I should say here and throughout, my remarks, I'm drawing on some joint work with my NYU colleague, Marcel Cahan, who's an expert on corporate law and corporate governance. And we have a recent paper in the Yale Law Journal about some of the mechanisms of anti-competitive common ownership, and we're exploring some related issues in ongoing work. Now, when I hear the evidence that we hear so far, and I hear the reactions of economists to that evidence, I would say the evidence is pretty mixed. I think it's mixed in two distinct respects. First, some studies find results and others don't. Now, this is true even within the airline industry, because in addition to José's very impressive study, there's also been, as a lot of people on this call know, some, I think, substantial critique. I think there's a lot still to be done here. There's other industry-specific studies and other cross-industry studies. I'd say that the results here, even taking into account a certain amount of publication bias for finding something, I'd say are mixed. Coming back to this big if true point, I would say so far there's not a consensus of economists, at least ones that sit in the United States, about the true part. And I think that's a big ground for caution. That is, I don't think there's strong support among economists in the U.S. for a strong regulatory action. I think there's a second way in which the studies are mixed, which is that there's a wide variety of measures of ownership, wide varieties of measures of outcomes, and they're ultimately testing different theories. And so you have some theories that aren't tested, some tests that don't necessarily have a theoretical foundation. I think the details here matter. I think there's reasons to be a splitter rather than a lumper in this space. Among them is the external validity point that was made already. I think we need to guard against temptation to lump together evidence against that really appeal to different theories and consider it too readily as additive or synergistic. I mean, take a step back here. Suppose we observe predatory pricing in the airline industry and price fixing among sellers of cement. Do those two things come together to give us some obvious policy conclusion? Well, it depends on our level of abstraction in a way. If we didn't have an antitrust law, we could put these things together and say, oh, there's a need for policy to do something. We need to act to curb corporate power among firms with market power. But it might not have an obvious implication for the exact rules that we should be implementing. That is, we might need more specific, domain-specific rules to respond to what we observe in different particularized contexts. So, I guess a couple of things for us to think about, just trying to draw together a few of the things we've heard today in formulating policy. So I think one important issue here that, sometimes just gets passed by too quickly is this troubling behavior, if we think we are observing troubling behavior, something distinctive to common concentrated owners? So, I think it's commonplace among probably everybody here that, shareholders in oligopoly like reduced competition too. So, I want to come back to Nathan's remarks in the earlier panel, where he's done an impressive job, pulling together public traces of conduct that might be described as concentrated common owners acting in a way to limit competition. Some of these examples, at least when I hear, I think, okay, but is that something distinctive to common ownership? If, an owner of an airline or an owner of an investor in shale drilling pushes for limitations in competition or in airline capacity, some of these are things that are common cause among maybe all shareholders interested in maximizing their profits. And so we need to think about what is added by the common ownership overlay. This isn't a new idea, but I think it's an important one. I think a second kind of caution to think about is, is the troubling behavior something distinctive about concentrated owners. So this comes up when we think about the, I think, fairly common theory, informal common theory, right? At least in the broader debate about common ownership, that of course there's less competition when index funds own everything because they can merely decline to press managers to act in a pro-competitive fashion. Something they hold in common with, a small, ordinary, everyday tiny investor. And so if passivity is the issue in this particular way, it's not limited to common ownership. And the measures that would be needed to test that kind of passivity, I think, are quite different from what we've, for the most part, seen in the empirical literature. You wouldn't be focusing on just common concentrated owners, but basically everybody except for the non-common concentrated owners. So you'd be measuring something different than what we typically measure, whether using MHHI or something else. I guess the final thing I just want to say for now, and then I'll stop, is does the proposed cure match the disease? So I think I'm coming around slowly to maybe where you started with your question. I think given the mixedness and the, I would say, still fairly early state of the literature at this point, we want to be quite cautious. I think under the current institutional arrangement, there's some upside to returns to scale from the pro-competitive benefits that we think concentrated ownership might provide outside the context of oligopolistic industries. So there is a question of losing something substantial, as José suggested earlier today, from jumping in in such a big way. And so that would lead me, just by a sort of negative implication, toward more specific.
Scott, I just have to push back. I mean, I agree that we should be cautious. I guess what's not cautious about allowing mutual funds to work undisturbed and allowing efficiencies that come from corporate governance to continue undisturbed by having a safe harbor of the kind. I mean, all that happens is that a mutual fund just doesn't buy United and American and Southwest and Delta. I'm thinking to myself that that's awfully cautious. So I don't understand what is making you nervous.
What makes me nervous about replacing the current institutional arrangement of index funds with a particularized decision by every substantial institutional investor about which airline they're going to choose, because they're not going to be indifferent, of course, between United and American and Delta.
I think that your local finance professor would tell you that they are. Stock prices are supposed to make them indifferent.
So you think that because they believe in an efficient market hypothesis, they won't remain in anything like continued business of choosing among firms, that there won't be, within Fidelity, say, the fund family, a decision that has to be made under your proposal. Are we going to be United? Are we going to be Delta? Are we going to be American?
Yep.
And once that decision changes, that there won't also be transition costs from winding yourself down
Okay, so
and then picking up the other one.
If you're talking about transition
Well,
costs,
no, I'm not only talking about transition costs. I think transition costs are one among several issues. If, in fact, investors select that horn of your dilemma, right, the horn of investing in a single firm within an industry, rather than basically bringing themselves down, right? That would be the likely alternative. It might be difficult to compete with smaller firms who then would have some costs of their own.
but we show empirically that
Fiona, may I suggest you switch on your video so there's a dialogue between you can actually see both?
sorry,
Excellent,
I didn't
fantastic.
know if you wanted to see.
Absolutely.
We may vary on that.
It turns out that there isn't a cost, Scott. We can show this empirically. We can go back and do a synthetic policy and look at the last 10 years. And you can see that holding one airline basically gets the job done. There is tiny amounts of diversification that you get from holding 4 airlines.
Yeah, I'm not making a strong claim about whether you are right or wrong in your view that the gains of diversification within an industry can be accomplished by holding just one firm rather than all of them. That strikes me as having an intuition behind it. I'm not wading into that.
Then, yeah, so then let me just say two more things. The studies, the mixed studies, no, I just have to say one thing about these studies, because it isn't the case that we would expect to see all the studies coming out the same way. I mean, for one thing, there's only one study that comes out saying nothing's happening, and that's breakfast cereal. But I also think in a world with complex common ownership and corporate governance, you would expect to get different answers across different industries. So I just feel like finding one industry where there's no effect does not absolve us of solving this problem. Sorry,
I don't claim, I'm not seeking for anybody absolution, but let me quote you. A number of recent empirical papers have looked at individual industries to examine whether the incentives predicted by the theory of common ownership appear to be present, with mixed results. So I think that sounds right to me. And I understand you're just saying about individual industries. I think that's true more broadly, too. And so the point isn't if there's mixed, there's stalemate, and therefore don't do anything ever, right? I'm not making that claim at all. And as I've said, I think this deserves a lot more attention and a lot more work. If I agreed with you that the proposal to basically restrict yourself to a single airline, I don't know what AT&T does, but to a single airline, let's say, or to a single beverage company, or instead keep yourself below 1%. If I thought that were small, if I thought that were conservative as you do, I might say, all right, well, like first, this is harmless, right? This is a no regret move, I think, is the way you've positioned the proposal. And I think it's a pretty radical institutional alteration, and one that I suspect has costs. And I've offered a few, and we talk about some others in the paper. But if you take that off the table, if you can make all the costs just go away, then the proposal does seem less radical in that light.
So, Scott, is your position that we should stick to a case-by-case approach until we really know more about the generality of...
Yeah, the place I was going to end until we got locked into a discussion of the specifics of the proposal was, coming back to Fiona's earlier intervention in response, I think we're in a relatively early state in our understanding the external validity of a specific industry-specific study. So, I'm relatively confident and comfortable in merger situations that we can make relatively confident predictions without getting crazy specific and exact. I think we have some robust generalities. The robust generalities are often, I should add, affirmed by the internal documents of the firm. So it isn't just economists making a prediction based upon a unilateral effects model or some kind of merger simulation. They're actually often confirming stuff we already see from, H&R Block's documents. Just to take a nice example, and probably the most sophisticated implementation of unilateral effects in the U.S., where the economics is secondary to the internal understanding of the parties. And in situations like that, the exact model doesn't seem so important. And I just don't think we have that yet on the common ownership context.
Yeah, and I think that goes to data. We aren't collecting data, and we don't have the 6B study. We don't have the internal documents. We don't have any discovery, effectively, of the kind Scott's talking about for this problem. So we're not going to get to the place he's describing until there's a more robust effort to get some data.
Yeah, and can I just offer a sentence just strongly endorsing the last thing that Fiona said? Because I think the absence of study by the agencies in the U.S., and that means in practice the FTC, because they have a powerful mandate to go do something, is a disappointment. I mean, I think one thing that should be on the agenda going forward at the FTC, because they have this authority and because they have shown interest in this topic, is to go do that work. I think there's plenty that has been done already to justify that kind of ultimately pretty modest investment of institutional resources to go do that.
Okay, so there's something on which both the lawyers and the economists on both sides of the Atlantic agree, which is the fact that it's worth researching more. I mean, it's not. It's worth investing in data on those issues to try to find what is the right answer. I mean, whether we can go to regulation or whether the more cautious case-by-case approach that you're suggesting is the only thing we can do. I just wanted to ask one final question from the panel. Interlocking directorates. I don't know whether you have, we have been exchanging documents. I don't know whether you've looked at them. But okay, clearly, first of all, what's the relationship with the common ownership? Does it raise the same kind of issues? Or maybe even more, because we're talking about members of directorate. Second, there are very different solutions in the US, where there's a much more strict approach in the US than there is, it's more like a case-by-case approach in Europe. What is your sense of what the issue is, and should we, in this case, in Europe, invest in more data, maybe to support a more strict regime of interlocking directorates? Fiona?
I think the economics is the same. We give directors substantial incentive pay. Usually they own pieces of the company, and obviously they're a director. They have a say in corporate governance. So I do think that you have the very same economic problem, but it's very clear what the mechanism is. It's power on the board of directors. For me, this one seems clear-cut, much easier to make a rule that just prohibits it than it is to spend valuable enforcement resources going case by case by case. It seems like it's just not worth having. There are many qualified directors. You could have one that isn't working for the competition.
So let me turn to our European colleague, Pierre, and Jean.
On this one, I completely agree with Fiona. You've got the mechanism, and contrary to what CEO tells you, it's not an extremely restricted set of capable people. So I would actually personally be in favor of a very strict rule.
But why is it, do you think, that there is no consensus on this in Europe, or not enough consensus that we've gotten there? Because it seems fairly obvious.
But not having ever worked on a case, I don't know. So I let Jean, maybe who has more experience on this.
Because Fiona just said something important. She said it's the same issue as common ownership, except that it's more simple. We know the mechanism. So in a sense, we don't need any more data or as much data as in the common ownership problem. Okay. So, no, and I had a symmetrical question for the U.S. Colleagues. In the U.S., there is a very strict and easy solution to the interlocking directorate problems. Doesn't that suggest that the common ownership might be a serious problem, and that how come institutions in a country where there is a lot of attention and a very strict rule on interlocking directorates don't seem to be all that interested in common ownership? Is it just the complexity, or is it that we're in a different time, or is it that there's been, competition authorities haven't done what they should have done, or?
A+ question, Fred. A+. Let's see if Scott can answer it. Maybe he knows something about BlackRock, for example.
I think there is a lot of interest. I think there's been a lot of thinking done about this.
I was talking about institutional interest in the U.S.
Well, I'm sorry, maybe I'm not quite tracking the question. By institutional interest in the U.S. and that has been lacking, what do you mean?
Yeah, that the FTC has not been, earlier on.
Well, that's what I was trying to answer. Yeah, no, I don't think it's true that there has been a lack of interest. I think there is interest, and I think folks read this material. I as I said before, am disappointed by the lack of a 6B study, and you're saying what's the reason for that? I don't know. Maybe we'll see a change in the next administration. Fiona probably has a better answer to that than I do.
Fiona, last word.
No, I don't have a better answer to that. I do think that as we get more papers from academics demonstrating different ways to study this in different contexts, and it becomes more familiar to our finance colleagues that what we're talking about is not necessarily some kind of collusion, but just the normal way in which partial ownership stakes and interlocking directorates have always been thought of, and that we need to examine them in this context. I think we're slowly changing the what you might call the default beliefs, and that will eventually work its way into the agencies.
Nobody has reacted to Ioannis' suggestion.
But I think
he can't hear.
I think that the question of interlocking, first of all, I don't think at the moment, and I know that Chiara's on this call, I don't think at the moment that we have any sufficient grounds to go ahead and pursue such a measure. I think what is interesting, though, coming back to what I certainly heard at a conference, and in terms of what has been said, is the link between common ownership and directorships. So if there were more, how can I say, evidence, if you like, that through directorships, effectively, or there was a strong correlation between directorships and common ownership levels, and that those directorships were voting. So that's another thing, because the different member states' laws also restrict the type of position you can have as a director as well. Then there might be grounds for it. But in any event, at the moment, the corporate governance law in Europe is hardly harmonised at all. It is very much, as I think it was Florence at the beginning of this conference said, there are different regimes across the member states. So if ever there were a move, it would probably at this stage be more at a national level, possibly through the development of corporate governance rules, than at the European level, simply because the regulatory framework is frankly not harmonised at this stage. And an example of that was very much what happened in Italy. The provision, the ban that came in following the sector inquiry by the Italian antitrust authorities was very specific to what they had analysed on the Italian market. And in my personal opinion, that was totally well-founded. But I can't see it at the European level, given the surprising, I must admit, but still it's true, fragmentation in corporate governance law across the Union as we're speaking. So I hope you heard that.
Yes, thank you very much, Jean.
Thank you.
Because there's supposed to be a single market, and firm A from France is allowed to compete with firm B in Germany. Then not having harmonized interlocking directorates is a major loophole in competition law in Europe.
We wouldn't agree more, Fiona, but that's the situation.
I agree. And there are many other differences. Okay, so Fiona, any advice to small countries?
Well, this is a super interesting problem. I know that we have literature in economics about firms being more cooperative when their managers have been to the same university, for example, or have social ties. So I think this is a very interesting problem, a very interesting regulatory problem, and one, again, where there should be some attention, because it's probably a place where competition enforcement is underdone in some way.
And it does say, I think, also something about the fact that there are good reasons for which competition law might not be exactly the same in all countries. I mean, when one talks about convergence and so on and so forth, there may be objective differences that require particular solutions, and this may be one. I think that we've gone past the end of our time, so I want to thank you for this lively exchange, and I'm sure that your call to have more research being done this is going to be answered because it is a popular topic and a lot of academics are interested. So to the extent that they bring more data and more convincing scenarios or more convincing explanation, there may be change down the line, even if it's too early to say that institutions want to move the regulatory way. Europeans tend to move in the regulatory direction faster than the others, so there may be some hope that eventually Europe is going to lead the way. But thank you very much for all this, and thank you to the organizers for having organized this whole conference and this last panel.
Thank you very much, Fred, for chairing this event, and what a wonderful discussion we had at the last panel as well as the previous ones. I think out of this day we see that, there is certainly some problem for sure. First at the theoretical level, but also we have some empirical studies done by people like José and Martin and Isabel and Fiona about this issue. The size of the problem, well, that might depend from industry to industry. We need more empirical research, both in Europe and in the US, as well as other parts of the world, I think. And in terms of intervention now, the question there is what type of degree of certainty with regards to the problem we need in order to intervene. And the second thing is, in terms of choosing the right tool, well, do we need to have the same type of degree of certainty? For instance, Fiona raised the question about the prospective analysis that we usually do in merger control, and the less prospective analysis that we do in the context of antitrust. But I think it's quite interesting also to think of other alternatives. We are discussing nowadays in Europe about the new competition tool. Some other jurisdictions, like Greece, for instance, have already the new competition tool in our Article 11 of the law. We actually have the possibility of doing more research, not academically, but also as competition authorities through sector investigations, inquiries. And I think, when we try to move towards this direction, maybe, we can start from this type of broader type of, interventions to understand what's going on in various markets, and then on the basis of the evidence we collect, act. And also, I think it's quite interesting to maybe think about the expansion of the common ownership and cross ownership, as well as interlocking directorates insights to other type of similar problems. I put forward the family ties issue, which I think is quite interesting for some jurisdictions, and important in particular in jurisdictions where financialization has been less advanced. And we don't really have too much institutional investors type of index funds, etc. Issues. And I think, by moving the debate forward, we can somehow, at some point, reach more consensus that will enable us to act through different ways. And I think this session today contributed to this collective learning that needs to happen in this area before action. Thank you very much again to all the speakers for their interventions, and we will post the full video on our YouTube page, as well as Vimeo, and also the webpage of the Competition Authority, the Hellenic Competition Commission. Thank you, and have a nice evening to all of you.
Thank you. Bye.
Thank you, Mr. President. As this conference is slowly coming to a close, we hope that some light has been shed on the topic of common ownership, interlocking directorates, and competition. It is our hope that today's JCLE conference has provided ample food for thought and an opportunity for further reflection on a much debated issue. We thank all participants, the moderators, the speakers of each panel, and of course our audience. Also, many thanks to the head of the HCC's Digital Communication and Public Relations Unit, Mr. Konstantinos Kourloumenos, for handling the organizational aspect of the conference on the part of the Hellenic Competition Commission, and of course to our event coordinator, Dr. Florence Thépot. as we have concluded our work, we wish you a good rest of your day, and in these unforeseen circumstances of a global pandemic, good health and strength. Thank you all. Have a good week and stay safe. Good night from Athens.